Good morning, good afternoon, and good evening, everyone, and welcome to our Winter 2023 IPO Bootcamp. My name is Colin Mahan. I'm a director of programs at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. We have a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. Secondly, we're going to open up for live Q&A near the end of each panel. So please submit those questions for us in the Q&A function at the bottom of your screen throughout each presentation. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including NASDAQ, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft, BPM, and HubSpot for startups. We're humbled by their contributions and hope you're grateful too. Now, before we get started, I'm going to launch a couple of polls to just take a step back and take a temperature gauge on how everyone's doing today. So the first poll is around how we're feeling about our businesses today. So the first one, how are you feeling about your business? Q4, the year's about to end. Are you optimistic, in survival mode, feeling a little anxiety or fear? We use this information to fuel the wellness and resources that we provide for entrepreneurs out there. So let us know. All righty, looks like optimism is at the top. So thank you for voting. And I'm going to end this poll, share those results. Optimism is in the lead, but there is a little bit of survival mode out there. Hopefully, our panels today will help. The second poll I'm going to launch is what's keeping you up at night? Is it finance, sales, marketing? We also use this information to fuel the next couple of months of our programming. So let us know. Ooh, looks like finance is in the lead, followed by sales and scale. Thank you for voting. All right. I'm going to end this poll, share those results. Looks like finance is in the lead, which is the topic of our conversation today, which is good news. And so without any further delay, I'm going to talk a little bit about the agenda for the day. So we're going to kick off our program with a market update and overview and jump into our first panel, which is preparing for and staying on track for your IPO, followed by a 10-minute break. Then we're going to transition into our second panel where our panelists will share executing your IPO, followed by another quick break. And to round us out, our last session will cover achieving success as a new public company. Now, the same Zoom link will be used for each session. So if you need to pop in and pop back out, you can totally use the same link. So without any further delay, please join me in giving a warm welcome to our first presenter on the IPO market update. Eileen Connors is a director at BMO Capital Markets. Eileen, welcome.
Colin, thanks so much. And to your point, good morning, good afternoon, good evening to everybody. I'm thrilled to be able to share some thoughts today on the IPO market and kind of get the day going. A couple things to think about and an update on where we are and where we think we might be going. So
happy to have you.
Yeah, if we're able to share the slides, that would be fabulous. Great. Thanks, Colin. Thanks, Anna. So we'll dig right in and can start off on page 1 here. If we want to flip to the next slide. All right, perfect. Thank you, guys. So I thought it made sense to just take a minute before we really dig in on just identifying who BMO is, who I am, where our perspective is coming from, just kind of couch this discussion in an update on, again, where you're getting this information from. So BMO is a Canadian bank that is really, it is North American in nature, but it is truly a global platform. So we're top 10 bank in North America. We are headquartered in Toronto. I'm coming to you live from New York. So we have a very significant U.S. presence, which most recently was really magnified by our acquisition of Bank of the West. So this was fully integrated as of just this past September. It's massively expanded our U.S. footprint, and it's been the largest bank acquisition in Canadian history. So $63 billion market cap company, over $900 billion in assets. We are really proud of our reputation of being a stable place and a very sort of thought-leading group of advisors when it comes to investment and corporate banking. So that's the platform that I'm coming from. Specifically on my background, I've been with BMO for over 10 years. All of that time has been dedicated to equity capital markets. So I'm currently a director in our equity capital markets group, and my responsibility is running our U.S. equity syndicate desk. So effectively, all of the execution of anything that is coming through BMO, specifically IPOs, is coming through my team, and that's across all different sectors and market caps and all different market environments. So it just gives you a little bit of context on who we are. We can flip to the next slide from there. So figure before we talk about 2023 and what happened, let's get right to it in terms of what we see looking ahead. And it's great, you know, Colin, you mentioned on the poll outcomes to have that optimism at the top of the list. You know, while we're not fully calling for an extreme bull IPO market in 2024, we really do see optimism setting in to allow for some openness in the IPO market in 2024. So the top part of this page is a proprietary model that we use. We call it our IPO barometer. And what it's doing is really visualizing IPO window receptivity. So when you speak with banks, when you hear in the news a lot about window-driven markets and what are good windows for IPOs to get out into the market, what this is doing is taking all of the macro factors that we think are relevant to deciding an open IPO market or a shut IPO market and visualizing it. So you see a lot of that red pattern in 2022 and the beginning of 2023, indicating what we all know on this line was a really challenged market. But the important part is the rightmost section, which is this inflection higher, to say that based on things like a low VIX, based on where we see the market going from a rate picture and just, you know, absolute levels of the S&P and indices like the Russell, we think we're entering a more open time frame. The bottom half here, again, I think it's important to set the stage on a macro level before we kind of get into the nitty gritty here. Where we at BMO believe the market is going is, first of all, from a rate picture, our strategists do believe we're currently at terminal federal funds rate, and that you'll start to see things drift lower in terms of rate cuts as early as the second half of next year. And from a market perspective, we do expect to continue to see the S&P grind higher, all to say that there should be improved visibility and improved market conditions to be able to launch an IPO. So we'll turn to page 3 from there. So really, this is a quick snapshot of 2023, what happened, right? And especially in sort of the final quarter of the year, there's been a lot of attention, whether it's on CNBC or just in terms of the names that have come public on an IPO market that was more accessible and able to digest transactions in a better way than, let's say, this time, certainly a year ago. So a lot of numbers on this page, and we'll break it down. But on the left side here, I think there are two real signs of health and an improved market. So the first was the market being able to digest large deals that were able to cross the finish line in terms of actually pricing transactions, garnering investor attention to be able to, again, achieve pricing outcomes and begin to trade as public companies. That may seem like a low bar, but that's something that I don't think we would have really been able to achieve a year ago. So large transactions like an ARM, like a Birkenstock, like Kenvue, that's not something that we really saw receptivity for billion-dollar plus transactions a year ago. So seeing deals like that come, especially those that had been in the pipeline for a very long time, that's a sign of overall health and something that the whole capital markets ecosystem was proud to see. On the bottom left side, seeing a replenishment of the IPO pipeline, and we'll talk about that a little bit more in just a couple of minutes, but seeing new companies register their intent to become IPO candidates. And again, just this getting away from stories that had been in the pipeline for going on 2 years and seeing new things to talk about and new IPO candidate stories. That's another thing that we think is healthy and sort of an important part of the end of 2023. On the right side of the page, this is sort of the profile, the average profile of what we saw over the course of the year. And I think one thing to really keep in mind as a caveat and as a guide for today is there's a significant range of outcomes that are making up these averages. So we did see over 30 IPOs for $20 billion plus in proceeds, but we also saw 3 names, again, Birkenstock, Arm, and Kenvue make up more than half of those proceeds, right? So there was a significant range in terms of size, in terms of outcome. Your average deal size was increased from 2022, but it also included a larger amount of secondary proceeds, meaning that a significant portion of dollars raised, and we'll touch on this in a moment, were not actually primary proceeds being put to work in the company, but monetization events for financial sponsors to be able to liquidate their positions into the open market. Overall, again, another theme that we saw, touching on the third row here, the sizes of deals as a percentage of total company went down. So across the market, it was just above 20% of companies were floated via an IPO. But if you take out biotech companies, which tend to represent or skew the data a bit higher, it was a bit lower than 2022 at about 15% of total company size being floated in an IPO. Again, a lot more information on this page, but would highlight just on the bottom here, the average IPO discount tended to be around 23%. The range of outcomes here was significantly wide. So some transaction actually pricing at a premium to peers, some coming at significant discounts depending on the moment in the market. So that's sort of how to think about the average. And we'll touch again in a moment, but average aftermarket performance up about 7%. That's healthy in the sense that investors needed to see that be a positive number in order to come into 2024 with some conviction in putting money to work in new companies, but it's certainly lagging the overall market performance of, call it 20% plus, if you're an investor and looking to invest just across the broader market. So again, primary takeaway here is a significant range of outcomes, but this gives you a sense of the profile of the year. So turning to the next page, there's a lot on this page, and there's a couple points to highlight, but I think the most important thing to think about is really the importance of relativity. So we do feel optimism coming into 2024. We are able to speak about 2023 as being a healthier market environment than we saw the year before. But the year-over-year comparisons haven't been normal in a long time. And that's what you see on the upper right portion of this. 33 IPOs for $20 billion is again, it's an improvement, but it's certainly not at the pre-COVID levels. That said, we also saw this unusual year-over-year comparison last year coming out of a wild time, frankly, to be involved in IPO pricing. So again, one of the things I'd encourage folks to think about over the course of today and the strategies that come out of today is what's normal? How do we think about what normal looks like? And again, trying to understand how to execute through different types of market environments, especially as we begin to understand what stable can look like. A couple other points specifically that I thought were contextually interesting, looking at the data back past the last couple of years. One on the bottom left-hand side here, that last row for average secondary component. Again, I mentioned prior that what this is really looking at is what percentage of dollars are new primary proceeds going to the company versus secondary selling from financial sponsors. 22% may not sound like a super high number in its own right, but compared to 8%, 5% in the pre-COVID years, it's significantly larger. And part of that, I think, as financial sponsors were backed up in terms of being ready or expecting to be able to bring deals to market, 2022 was so closed that, again, a lot of the IPO dollars that came this year were secondary events. And that's just, again, something to kind of keep in mind, and certainly at the forefront of investors' minds, thinking of the next class of IPOs. Again, what are the dollars being used for, and how does that look over time? So certainly a standout statistic for the year. And then another note for this page, again, in terms of relative context, is on the upper right, looking at that IPO performance. The overall increases in IPOs on average have been present. These transactions have tended, again, not on an absolute basis, but on the majority, have tended to trade up over time, not in a magnificent way, but in a stable way, in a healthy way. So you saw an average one-day increase of about 12% from IPO price, and then an average one-quarter increase of about 5%. Again, so that dynamic of a one-day pop still existed, but companies were able to sustain this type of performance over time, which again is less exciting for the average investor, but it's really important to see that health. The other thing to keep in mind here is, the elephant in the room for 2020 and 2021 in terms of IPO issuance was wild outperformance. So you see the 1 month pop of 50%. We hear these storylines of all deals trading higher and just this, frankly, euphoria around the performance of IPOs. Those vintages remain suppressed. So if you see that average offer to current, we still are down for the 2020 IPOs, an average of 32%, down an average of half for the 2021 class. So that persistence of the scars left from some of the relative underperformance in today's world is still very relevant. And so therefore, I think all the more important to see this year display some health and stability in terms of the overall aftermarket performance. So we'll move to page 5 from there. Okay, so here we have, I really like this slide because I think it's a good way even to think about today. And as you ask some of the panelists questions, what are the things, the controllable things, the pieces of the narrative that are going to be important in every market? And then what are the extra sensitivities in this market, right, at the end of 2023? So the things on the left-hand side here are a quick list of factors that we believe and we've seen, and I'm sure our panelists will reiterate, are important regardless of the type of company, regardless of the market environment. These are still very important things to focus on. And, throughout 2023, there was no deviation from that. So something like the importance of a strong management team. This couldn't be iterated enough. It was a consistent theme in each of the transactions that came for management to be able to tell their story in a way that resonates with investors, to really be able to connect with the right partners at IPO, and establish the right to be a public company and execute as a public company. That's not going anywhere. The right-hand side, we see some sliding scales of relative sensitivities right now. So to hit on just a couple of the, let's say highly sensitive topics, first of all, IPO discount versus peers. We don't see this going anywhere. So what we mean by that is, in the mind of an investor, what is the necessary discount to make an IPO situation compelling, to intrigue an investor to put money to work, in a new company? That's been a really, really relevant conversation, especially in the last few months. How do you, is the right peer set? What is the proper discount that should be associated based on the specifics of that company, that moment in the market, and really the unique attributes of any of the transactions that are coming to market? That's really going to remain relevant. And we do believe that, with some exception, investors are going to continue to really demand a discount for companies that are looking to come. Leverage, right? So call it, a third of the way down the page here. This is a high sensitivity that we think really will not only remain high, but go higher in terms of the minds of investors. Understanding for companies that are new to coming public, how does their leverage profile compare against their peer set, right? Again, that concept of what's normal and how does this new company sort of relate in that landscape. But also in a current rate environment, how can a company manage its debt load? And how can investors think about maybe not only the absolute leverage levels, but interest coverage ratios. How are you set up to navigate a changing rate environment, especially as we try to glean more about the pace of change and a potentially higher for longer rate environment that's going to remain highly sensitive. And finally, on my high sensitivity list here towards the bottom, early lockup structures. This is one, and when we say high sensitivity, it's really an intolerance, frankly. So early lockup structures, we think back to the 2021 vintage, for instance, and several companies had potential carve-outs where if performance of shares were above a certain level, the company would be automatically released from their lockup, which typically would be around 6 months. Structures like that, that could potentially allow more stock to break free before what would be considered market standard. That's really gone away. That was a sign of a euphoric market. It's really gone away, and the power there, if you will, has shifted back to the investor to say, we're really looking for conservatism in terms of a structural setup at that IPO moment. We can turn to page 6 from here. So taking a second, again, away from sort of the standard market update to spend a moment on something we thought was a really interesting trend in 2023, and that was cornerstone investments. So what we mean when we say cornerstone investments is several transactions that came to market on the cover of their prospectus had indications of interest publicly declared from what we would call high quality investors for a significant portion of the deal. So this included, situations where the investors were already invested privately in the business and were continuing to support the company, but in many situations it also included new investors. So on the right-hand side of the page up at the top, it shows a selection of, transactions that did include this, and you can see just the variety of both company types and really the variety of investors that chose to engage in this practice. So why is this important? I think a couple of reasons. Number one is, if we think about how we as a capital markets, again, ecosystem navigated the 2023 environment, de-risking was so critical, right? Explaining to the market at a moment or several moments where there was lack of clarity and lack of visibility on a macro level, why should this new company come public, and how can the investment community have conviction in the strength of that IPO moment to cross the finish line? For companies and for banks and for investors to be able to explain that there was not only demand, but quite high quality demand, message to the entire street that if you participate in this offering, frankly, you're in good company. And that really enabled some of these IPOs, especially if we think about those from late spring, early summer, think about a name like Kava, for instance, to really block the noise out and be able to get through the market. So if you look at the stat on the upper right-hand side here, 38% of transactions this year included these cornerstone investments. That's versus 18% in the prior 2 years. So it was really an important, almost like a life jacket, right, for these transactions to get through an unusual time, a difficult time, and really, put some important progress into the market. So that's the first reason I think it's an interesting thing to think about. The second is just as something to watch. I think that as we enter into 2024, this type of a solution or this type of a detail for a transaction is not going to be for everyone. It certainly shouldn't be for everybody, but it is something to think about, especially, if anyone is engaged in testing the waters processes or thinking about, how do I structure the conversations I have with investors, even on a non-event basis. This is just something to be mindful of. If you are in a position where, this does make sense, it does, present an opportunity to make an IPO moment that much stronger. These are conversations that you want to be aware of could happen down the line, and something that was definitely an intriguing part of the 2023 landscape. We'll turn to page 7 from here. This is just a quick list of what's up next. And two things I think take away on this page. Number one, Reminder that when a company publicly files their initial S1, there's a 15-day cooling off window between, again, that moment of filing and when you are first eligible to launch an IPO. So 18 companies currently fit that description. And you'll see in that second column from the left-hand side, the majority of these are well past that 15-day clock. But in terms of the known universe right now, these are the 18 names that if they wanted to launch something right away, they're ready to go. They're eligible. This gives a sense of what's out there. But I think the more interesting thing and the more important thing to keep in mind as it relates to the pipeline is that bottom comment here, which is that the activity that's going on is significantly deeper than what's just here with the 18 names. So we know for a fact that over the course of really the past couple of weeks, think post-US Thanksgiving, before we hit the holidays, a resurgence of testing the waters meetings has been very standard. We've met with a lot of investors over the course of the past couple of weeks, and everyone has reiterated that the number of companies coming through to see them in hopes of hitting that public filing window in January, in the beginning of March, that's only ramped higher. And so while this is the base going into 2024, we really do believe that you'll see a more robust pipeline build out over the course of the beginning of the year. And finally, we'll turn it over to page 8, which is my last slide here. And this is, really where the real questions lie, right? Which is, what are we walking into in 2024? So I have a couple of themes to think about and just sort of explain how we at least see the world coming into the new year. So first up is this continued focus on monetary policy. This is really the elephant in the room when we have conversations with investors, especially those who are very tuned into capital markets and look at a lot of really look at everything, look at a lot of different situations. This is going to be the most important macro happening for the year. And we really do believe that actually may supersede concerns around a presidential election or potential impact of that. So when we talk about the rate environment, we talk about monetary policy, really what that means is absolute levels, right? So where are rates, relative levels, what's happening in the US versus the rest of the world, and what implication does that have for global investors? And most importantly is really visibility. When can we start to expect rates to decline? What is the rate of change? How should we anticipate seeing the second half of 2024 and beyond play out? And again, just using that back half of 2024 as the first potential catalyst for change does seem to be market consensus when we have conversations with investors. With that in mind, and against that market backdrop, it kind of goes into the second bucket here, which is in the near term, we do anticipate IPO activity that does come to focus on those mature, durable companies that are profitable, have experienced management teams. That's not changing anytime soon. Focus from investors on that consistent quarterly execution over time. How can you as a management team explain your business, not only through a post-COVID bump or during COVID bump, but what to anticipate in a more normalized environment and how to create visibility for investors as you look ahead. So businesses like the financial sector, we don't see enthusiasm fading there at all, certainly coming into January, February timeframe. I think about a pipeline for a sector like insurance. There's been a lot of enthusiasm there. We don't see that going away in the near term. Third bucket, again, we talked earlier about primary versus secondary proceeds, and some excitement, real palatable excitement that we've heard from investors in the past couple of weeks is the chance to underwrite or invest in dollars that are being put to work for good identifiable uses of proceeds in companies. So seeing the M&A landscape improve and being able to underwrite dollars to fuel that's exciting to investors. Allowing companies to manage their debt load and kind of create a more optimized capital structure for a new environment, that's really exciting. So this is something to keep in mind, not only for the openness of an IPO market, but also for those already public companies and how you see equity issuance behavior work out, again, for the peer set. that's going to be important as well. And finally, it's pretty unbelievable that we've now been talking, for call it over 20 minutes about the IPO market, and we've barely talked about healthcare and tech. And in a normal market, as many of us know, that's going to be certainly over half of dollars and really over half of conversation. So I want to spend a second just kind of setting the stage for both of those sectors. In terms of life science companies, we really do believe that the wallets to put money to work in strong life science stories, that will continue. And those companies will continue to be funded, certainly privately, also publicly via IPOs. Where we do see the caveat resting in the current market environment is the attention on later stage companies. So whereas a few years ago, we did see a lot of activity for, for instance, preclinical candidates or earlier stage companies, now we're really seeing this emphasis of, do you have in-human data? What is your path towards data readouts? That's, again, where we really see this interest crystallizing. And again, this representation from existing investors in the IPO is going to continue to be a theme. This is something we've seen in the healthcare market for several years. That's not going anywhere in the short term. And then finally, technology. And I think this is probably a good place to kind of end the thoughts. We'd love to be able to say right now that, tech is ready to go, and we're ready to bring a lot of new technology IPOs to market. We're not there right now. And that emphasis on growth in terms of IPO viability, that's not there right now, but it is coming. And when we speak with investors, we certainly hear enthusiasm for Q4 2024 as potentially being the first moment, but really a lot of focus on 2025. And so for those companies that have been strategizing through a quite difficult market environment, as this all begins to reopen, you're setting up for a potential banner year, whether that's, the close of 2024 or more likely into 2025. That the quality and the interest is going to only build. And, just to kind of close on that note generally, I think in order for that to happen, days like today are so important to set the strategy, to try and figure out, how can you best approach an open market window in 2025? Well, it's preparation, and it's getting in a position to be ready, getting ready to be ready and take advantage of an open window when it does ultimately occur on a wider scale. Because at the end of the day, it is coming. We do believe it's coming. And the increased visibility that we can get between now and then is only going to help better understand, what exactly that's going to look like, and just how powerful of a funding moment that's going to be moving ahead. So that concludes my prepared remarks, Colin. I'm happy to leave it there, take questions, or whatever is most helpful.
Amazing. Well, thank you so much, Eileen, for that optimistic overview, and what a beautiful bridge to our next panel. There's a couple of questions in the Q&A that aren't directly on your slides, but they're asking if we will be distributing the slides to the attendees.
Yeah, I think that should be totally fine. I will double check, but that should be no problem at all.
Awesome. Well, thank you so much, Eileen. And up next, beautiful bridge to our next panel, which is preparing for and staying on track for your IPO. So please join me in welcoming our moderator, Melissa Rick, who's a partner at Wilson Sonsini. We've got Michael Ferrero, who's a partner at Woodruff Sawyer, and Francois Chadwick, who's a partner at KPMG. Melissa and team, take us away. So happy to have you.
Great. Thank you. So I'll be moderating this panel. My name is Melissa Rick. I'm a corporate partner at Wilson Sonsini, and our primary focus is tech and life science companies. A huge part of my practice is getting companies ready to go public and then taking them public. And the years ahead of that with financings, equity, governance, as part of my practice. And maybe I'll let both the panelists also introduce themselves and talk specifically, what part of the IPO process do you really get involved in here? Whoever wants to go first.
I'll jump right in there, Melissa. So Francois Chadwick, I'm the national partner in charge of our emerging growth practice here at KPMG. actually based in San Francisco. This is my third time back at KPMG. Took let's call it a sabbatical out of KPMG for the last 9 or so years. I spent a long time at Uber. I was various different roles up to and including acting CFO. I scaled the company, took it public. And then I joined another couple of other disruptive companies, taking another one of those public through a de-SPAC. As I say, I run the practice as it relates to getting companies ready for an IPO. I'll pass it over to Michael.
Thank you. And I'm Mike Ferraro, one of the partners at Woodruff Sawyer, specializing in directors and officers liability. So where I sit is at the time where our large private companies, they're in the midst of this transition to going public, and boards of directors are real finicky in making sure they have insurance to protect their personal and limited liability. So this becomes a top priority for the senior management to make sure they have ample coverage, that the board is satisfied that they have their personal protection in the corporate balance sheet. So we work with our firm as represented and has a largest market share of IPOs nationally. And we do really well also in the California marketplace. We're headquartered in San Francisco. And so we work with a lot of the Silicon Valley IPOs in the biotech and tech space.
Great. We'll jump right into the questions. And I think one thing we want to focus on specifically today is timeline. And for those of you that were able to hear the BMO presentation, it was great on kind of how they're seeing the market unfold over the next couple of years. But for companies, it's often difficult to figure out when's the right time to get started. We're all very cautious about spending money, about expenses. What are things that we can do now to get started and get prepped for an IPO so we don't miss the right window when it does appear for us? So maybe, Michael, you can answer this first, and then we'll go on to our other panelists. What are some of the no regret steps that companies can take now, especially given this market dynamic, to start getting ready for their IPOs?
I think about the structure of the finance and legal functions as well as the board dynamics, getting that right early. So what do I mean by that? Oftentimes you want, on the CFO side, somebody who's got public company experience, who's going to be that finance leader, if you will, and then have that person build his or her team in terms of a couple of the key positions. A really strong corporate controller becomes really critical in that position. And depending on the business, if you're non-biotech, a chief legal officer or a general counsel, it can be a really important role, and also having the support function of the legal team. I also want to emphasize the importance of the role of the board, especially at a time of a transition from a private company to a public company. Really getting that public company board experience dialed in, ideally a year before the IPO. It gives them ample time to really get a feel for the company, understand the inner workings, and have an idea of what some of the objectives are and how they can help in their respective roles. And in particular, for companies that are revenue driven, I think the audit committee chair is a really critical role, and they can be the best friend of the CFO and really help. So I think those are key roles. Why do I note that? One of the largest areas of allegation, so then in my purview, we see a lot of shareholder litigation. That's what the D&O insurance policy is protecting. A very large percentage of class action suits are around missed earnings projections and revenue projections. And so this is a function in which that audit committee chair with that experienced CFO can really make a difference.
Yeah, Melissa, I would sort of take some of the comments that Michael was making. The normal timeline we would see for a company to sort of be prepared, especially from a sort of a finance, but an overall perspective, is sort of that 12 to 18 month window. And so if you take a step back and listen to what Eileen was talking about, where, maybe the markets are going to open up somewhere in 24, maybe the back end of 24 into 2025, we're in that 12 to 18 month window right now. But then you've got this natural tension. And even Michael, you even mentioned it as well about formulating the boards, getting the right people in that 12-month window. But then Melissa, you did mention the sort of the tension around spending and doing things now, which may be that no regret sort of thing. Whereas, do you really need to spend right now for something to go for the full IPO when that may be 2025, but it could be late 25 or where it could be. The one thing I would always say is, having taken a company public through a traditional IPO and having taken one through a SPAC as well, is whenever you've gone and you are a public company, you need to be able to act like a public company before you are a public company. That's just a given, and we've seen some of the companies that maybe not as successful because they weren't ready. But when you look at the things that I would say are the no regret things, it's somewhere sitting in the operational aspects of the business. So if I think about like finance and financial operations, a no regret thing would be making sure that you can close your books quickly and accurately, and looking at the process of closing those financials on a monthly basis and being able to say, are we closed? Do we need to keep reopening the books? How long did it take to close the books? How accurate do we actually do we feel about them? And then coming back to something Michael was talking about, where we're seeing some of these litigation issues, is the ability for you to forecast. So look at how can you close the books, make sure you've got accurate figures, and then looking forward, what things have you got in place? What processes have you got in place to be able to do those forecasts? These are just general things that are actually best practices for any business. And they're low risk, they're no risk, they don't take up too much time, and they will actually make the business better, whether or not or whenever you choose that it's the right time to go public.
Yeah.
Melissa, if I can add one more thing to Francois's comment, on that theme of what he was emphasizing, I think the importance of a mock earnings call at the end of the quarter. It incorporates what Francois was talking. How quickly can we close the books? Is the management team ready to speak to the investment public? What is potentially going to trip them up? Those mock calls can be really insightful because it takes one bad quarter to really impact very negatively the valuation of the company. And so I think having practice goes a long way. And that's something I see some of our clients from a best practices do before they go public.
Yeah, that's a great suggestion. And having maybe your board or outside advisors sit in on those calls and, be your pretend public can be helpful in getting in front of that. So maybe building a little bit on this, and Francois, let's start with you. When you're looking at that 18 months out to actually listing, ringing the bell, pushing the buzzer, like big party, what makes up that timeline? What is that typical? Can you at a high level break down what a typical IPO timeline looks like?
Well, I think if we start at the front end is really making sure that you've started to get every sort of organization within the business ready to go public. So, you hear different things like an IPO assessment, an IPO readiness, or an IPO awareness, but you've got to look at everything through the business. So it's, finance is obvious, but you've also got the legal group. Michael talked about that. You've got the HR group, and then you've got the whole C-suite. And so those are the sort of things you've got to start to think about internally. And then obviously you're going to run up, and I'll dash across a number of different things here, Melissa, and we can come back to them. Then you've got to think about your org meeting and the presentation there. You've got to think about choosing your bankers, making sure you've got all your external advisors lined up. Then, of course, you've got to start to create and craft the story of what the business is and making sure that everybody understands that and it's something that's going to resonate with the market. Then you've got to the piece where you're going to start to test the waters, you're going to do the roadshow, and then you're going to launch. And all along all of that, what I find, Melissa, especially from my days as being an operator, is you've got all these people that are coming in that are going to help you. But if you're within the company, you're within the business, you still have to operate the business, and you still have to scale the business, grow the business, launch new products, launch new markets. Because what you cannot have happen, Melissa, is that you become so focused on that IPO path that by the time you're ready to go, you've taken your focus off the business and you don't have a real business anymore, right? That would be one of those Shakespearean tragedies, which is like, great, we're ready for the IPO, but the business is not where it needs to be. So that's a quick run through, I would say, on the calendar of that 12 to 18 months.
Yeah. And I think along like the business needs to be part, just to chime in a little bit from my perspective, like the types of companies that are going out right now are a little different than the types of companies that were going out in 2021. The market's looking, like our friend from BMO was saying, for more mature companies. So I think some companies that were thinking they were going to go out a couple years ago are now 4 years out, 3 years out, just because of market appetite too. So you need some flexibility there.
Yeah, and I think, sorry, Melissa, I'd say, and I think with that very comment there, that means that, some companies that may have been thinking of going out are going to have to start to think maybe more around private capital and other forms of capital that they can actually raise to bridge them to that point where they may be able to go out. So there's going to be those other discussions as well. And of course, the M&A market, and Eileen touched upon that in her presentation, the M&A market is going to get interesting over the next couple of years as companies think about what actual capital they've got on their balance sheet to be able to potentially meet or not.
Mm-hmm. Yeah. Michael, is there anything you'd add to that in terms of just overall IPO timeline?
Distraction is a real issue that Francois was talking about, and keeping the eye on the ball on the business itself still has to be priority number one, or otherwise you're not going to have a successful IPO. So you're managing two full-time jobs really in that process, but the number one priority still has to be in the business and the growth and the health of the business.
So when we think about an IPO timeline and some of these action items, what are some of the items, we talked about this a little bit, maybe we can go in more detail, that take the most time? When we work with clients, we kind of say, here's the things you have to do in advance. And I think, Francois, this will be the question for you at KPMG. And there's some things like, hey, if we have to do it in 2 months, we can. We'd love to do it earlier, but if we need to, we can kind of, and especially on the legal side, a lot of the answers are like, we can do it fast if we need to. But I think on the finance side, it's not really the same answer. So can you talk to, from your perspective, what are some of those items that are just going to take a long time to get done?
Yeah, Melissa, I think you're right. There are many things that you can sort of move around, you can push around, you can actually condense the time frame. One of the questions I do get asked is, and we can touch upon this a little bit later, is some of the things around controls and internal controls and Sarbanes-Oxley. Mm-hmm. Some of those things can be moved around a little bit, but I think just in the finance space, I mentioned this before, or alluded to it, closing the books in an accurate fashion and being able to make sure that you can do all of those reconciliations so that you feel very, very comfortable that those financials are complete and accurate, right? It's one of those things where when you go out and you are a public company, you want to make sure that those financials are really locked in and that it ties as well to the story of the business, because what you cannot have is a situation where the numbers keep moving and the story of the company then has to keep being changed. I think and so in order for the CEOs, CFOs of the world to be able to explain what the business does and where the business is going, those numbers have to be very accurate. And so you've got to be able to build a team within finance, and obviously the size and the capability and the capacity of your finance team does depend upon the company itself and the magnitude and the geography and whatever else and the size of the business. But having a team that you can rely on, because once you've gone public, it's like I say, I've always said to the legal teams and the finance teams, going public is like the Super Bowl for those teams. And it's like, once you've gone out, but the problem is the day after you've gone out, you've got to get over the champagne and be ready for that first quarter. And you cannot miss the first quarter. So that, in my mind, is what takes quite a bit of time. And it's, like I say, it's sometimes it's some of the things that you might not really think could take a long time. So in my prior experience, one of the things we had to focus on was making sure that we got all of the reconciliations done, because the audit firms are going to audit those reconciliations to make sure they feel comfortable that the figures are correct. And so creating a process for all those reconciliations, as in the weeds as that may be, can sometimes take time. And depending on where you're starting from and depending on what technology tools you may or may not have within your company, those things do take time. And so it's funny, but those could be the long poles in the tent just to get the finance function ready. And similarly, I touched upon it. When you think about controls, there's a whole discussion about Sarbanes-Oxley and being ready for Sarbanes-Oxley, but there's still a need to have a certain set of controls within a company to actually feel comfortable that those figures are actually correct. And those controls could actually be across various different organizations within a company. So they may not just sit in finance, they may sit within the IT function, they may sit within the HR function. And so when you start to have to do multi-org discussions and multi-org sort of implementations of controls, that just takes longer as well. So those sorts of things are the long poles. Those sort of things do take time. And the one thing I would say, Melissa, is just as I'm going to round this out is, and it's a question I get asked, is would I recommend a PMO, some sort of project manager officer or some person to run the IPO readiness and whatever? And I always recommend that this should be, especially when you start to do these things across the organizations, because then that person can see everything and help to drive it to a timeline.
Yeah, that coordination is really critical to getting ready. Michael, is there anything you would add to that?
I hear my clients talk about, and I think this is on the theme of what Francois was talking about, is automating those controls and automating the process. He referenced, different technology, but a lot of times you hear, or I hear, a lot of manual functions for closing the books, and that takes time. And as a public company, you have to do that sooner. So automating is, I really think, an important theme in terms of the context of what Francois described.
Yeah, that's a really great point. So I want to shift our talk and maybe talk a little bit more about, like, who are the players here? Like, what are their roles? Who are the advisors? How should we think about them? We have, all three of us would be considered kind of outside advisors to a company to some extent in this process. When I think about the IPO timeline, a big part of that timeline is, when do we have our org meeting? When are we, like, in true starting that? We do so much work ahead of time, and that we talk about 18 months. We're really thinking like 4 or 5 months out from that bell ringing. We're in earnest working with the entire working group. But sometime before that, you're going to start hiring advisors. And when I talk advisors, I'm talking bankers. Hopefully you already have your auditors, lawyers. You're going to be talking to someone like Michael on D&O insurance, and possibly others. So for the two of you, and Francois, and, being inside a company even, like, how do you think about going out and hiring these bankers, lawyers, auditors? What are those characteristics? And what sort of roles, are they playing in this process?
Michael, do you want to go first on this one? And
why don't you, Francois? I think this is more in your bailiwick.
Okay, no, not a problem. So I think, Melissa, you've touched upon them, but you've got your lawyers, and you want to make sure that your lawyers, you've got your corporate lawyers, but also dependent upon the business. There may be other lawyers that you need, dependent upon if you're in a regulatory environment or you're in some other environment like that. You're going to maybe need those lawyers as well to be able to come in and advise. You're going to need your auditors and accountants, as we mentioned, and hopefully you've got all your audits clean and ready and they're good to go. And if not, you're going to be playing catch up. You're going to, as I say, maybe have an advisor who's going to help to do the PMO and the audit readiness assessments and things like that. Now, moving to your bankers, you've got to start to think about which investment banks you may want to bring in, and this is where you have to have what they call the bake-off, and you will bring in a number of different banks, and they will present as to why they think they're the right bank to be working with you. And I've been through a few of those, and they can get quite interesting. And in certain instances, you may, depending on the size of the actual float that you're looking to do, you may have a primary bank and a secondary bank that's going to be working with you.
Mhm.
But what I would say, and then of course you've got to choose the market, right? And obviously, NASDAQ here, we're talking about this. It's like they choose the market and understand what the market's going to give you. And the market does help you a lot. They can introduce you to people. They have a lot of technology tools themselves that you can be using. They have CRM, customer relationship management tools, and all sorts of other things that go alongside that as well. Michael will talk about D&O insurance and other aspects like that. The one thing I would say when you're thinking about choosing all of these folks is it's got to be someone who you can work with for the journey. It's got to be someone you can trust, because somewhere along the path, something's not going to go quite right. You might slip up. There might be a date that's missed. You might find that there's a thing that you thought was not going to be too difficult, but it turns out to be quite difficult. And you're going to have to get in it with the people and start discussing it more and more. And so the more that you can be in there talking to people that you trust and can work alongside and are willing to invest and understand the people within the company and the other advisors, and be there understanding that you're all part of a team, that to me, Melissa, is like some of the most important aspects.
Yeah, I think
Michael?
that's a great way to say
sorry.
it. I'll just jump in really quick and then turn to Michael on that last point you made. When we talk about IPO preparedness, we say we love to do everything we can ahead of time, because what we do know is that something's going to happen. We don't know what's going to be. It could be something in the business, something with SEC. We've dealt with government shutdowns. We've dealt with COVID. It's unpredictable. And so it's nice to control the things we know we need to do up front. And I think that goes very key to the IPO preparedness and all these things you can do that you need to do, because we have to be ready for the unexpected, which will certainly happen in this process. Michael, what else do you have to add to that in terms of thinking about like the outside parties that companies use here?
The theme of the role that they play, and kind of building off of your comments, both of your comments, chemistry and somebody who really demonstrates a true partnership. And it's hard to describe, but when you feel it, when somebody is really invested in your success and looking for it at the longer term. When obstacles occur, when difficult situations happen, those are the people who often respond best and feel like part of the team and feel very engaged. What you don't want to have happen, as Francois mentioned, is when something does happen, because nothing goes perfectly in this world, that person not to feel invested in with the rest of the team. So that chemistry partnership is really important theme that was been hinted here.
Great. And a separate question maybe for you, Michael, and to shift gears here. We've talked a lot about like finances and all these other things, and you made a comment early on about more corporate governance type of preparation. Can you speak a little bit more towards what are some key corporate governance issues that late stage private companies should start on when they're thinking about going public?
Sure. So something that's probably near and dear to the D&O, but it is a bigger theme for the organization, is making sure you have choice of forum provisions in your bylaws. We want to be able to limit, and what we're speaking to is how securities class action suits can be brought. Unfortunately, they're prolific. We see 2 to 3x the amount of litigation for young public companies as we do mature public companies, and there's a whole host of reasons of why that's the case. But the ability to limit their venue shopping in state court versus federal, especially with a state like California, and there are jurisdictions in New York and other parts of the country where certain areas are known and notorious for being very plaintiff friendly, and even if they don't have good source of allegations brought against you. So this choice of forum provision, which is often baked in, and I know right up your alley, Melissa, in terms of incorporating as part of the process from a legal standpoint. In that theme, personal indemnification agreements, this can go a long way, just getting people comfortable that the company is going to protect them. Even if down the road there is a separation, this agreement survives that separation of leaving the board or leaving the management team. And then the other themes, and they may not fall within corporate governance, but if we think of it from the perspective of what do D&O insurance carriers care about, they want, I mentioned before, they want companies that the CEO, CFO, general counsel, and boards have had prior public company experience. Underwriters would prefer not to see material weaknesses in financials, going to the theme of starting early with your auditors and be able to build that and oftentimes it's because the finance function and the finance team wasn't built and couldn't support and to get to that outcome. And finally, I'll make a comment just from a risk perspective, not a governance, but a company, if we're not talking about biotech, companies that are on the path to profitability are already wildly profitable. It's a kind of a flight to quality theme that is important in the underwriting process.
Mm-hmm. Yeah, we're hearing a lot of talk of Rule of 40 in all the board meetings I sit in, and for companies, just a focus on profitability, like you were saying. It has really, really shifted in the dialogue on when companies are going to be ready for the public markets or potentially for other transactions. So to build on that point a little bit, we've talked a little bit and really enjoyed the presentation from BMO on trends that are happening here. With all the uncertainty in the market, I think we're seeing increased trends on kind of balancing doing private financings, IPO, direct listing, dual tracking, M&A, like kind of throwing everything up there and trying to figure out the best path to go. Could both of you maybe speak on sort of the key factors that companies should consider when deciding between the various tracks, how like not to get distracted, but at the same time leaving their options open when these exit opportunities are looking so uncertain?
Melissa, I'll take that. Michael, go. You can please.
Mine will be briefer than yours because I know you got a lot of experience here. But a couple comments I'll make is I touched on the theme of prioritization, understanding a company's objective is to maximize the value for the shareholders, private or public. But if you try to do too many things, we were just talking about what's involved in the IPO process itself. If that, realistically speaking, at the board level, of the senior management level, is a third or fourth priority, my feeling is don't spend the time and effort of building that function, of talking to bankers, going through the filing process is going to be a huge distraction. If it is in the top two between that and some type of sale or some type of M&A, then absolutely you have to go full force and keep those options open. But I think the prioritization is really important. The time invested in these processes, it's a full-time job by itself. You've heard us say that as well. The cost associated with that isn't inexpensive. And so I think that has got to be a real important thought into the process of how to manage this. And Francois, I'll let you pick it up from there.
Yeah, no, you definitely captured a few of my thoughts there as well. I think, what we're seeing is a number of companies that are looking at potentially the sort of the dual pathing things right now, waiting to see how the markets will react and then adapting to what Michael just mentioned there with making those choices like in 2024 and into 2025. I mean, at the end of the day, focusing on the business, focusing on improving processes and controls and just efficiencies within the business to get to that path to profitability. And at the same time, ensuring that there is going to be some available capital for whatever they wish to do is always is just the right thing to do for any business. It is clear that there is an incredible amount of dry powder when you start to look at the VCs and the private equity funds, and then you start to, and if you add in sovereign fund and sovereign wealth and family wealth, there's so much dry powder out there that people are looking to deploy some of these funds, and are becoming aged, and so they're going to have to take the money and deploy that capital. And then when you start to think about a mix of the portfolios within the PE funds, within the VC funds, there is going to be something that I expect we will see in 2024, into 25, which ties to what Eileen was talking about. When the markets open up, there's going to be portfolio companies that are going to be asked to go public because their funds themselves will start to invest in earlier stage companies, more in the A, B, C rounds. And then in order for the fund, whether it's PE, VC, or sovereign funds, to have that balanced portfolio, they're going to have to start to exit some of those companies one way or another. So however a company is thinking about it, dual tracking right now, however a company's thinking about it, anything that can be done, back to your initial comment, Melissa, about sort of the no risk, low spend activities that just make sure the company is in a better place from an operational standpoint, financial operationals, legal operationals, HR operations, and controls, that's going to put them in good stead, whatever happens. And then obviously, when you start to think about the actual forms of listing, you know, the de-SPACs are not as prevalent, very much not as prevalent as they were in 2021, although there are a couple out there. And then when you think about direct listings, there's only been a few of them, and those direct listings are really they only really work if you are a known company. So you've got to have some sort of consumer element to them to have that direct listing to make it successful. And I would also say, if whoever's going to think about direct listing, make sure you have a really, really good stock admin person internally within the company, because a lot of the work that gets done by other parties suddenly becomes an in-house responsibility for your stock admin person.
Yeah, and we're seeing a lot more pressure on those stock admins, I think, even in more traditional IPOs, because one point that Eileen made earlier is this early lockup release or even secondary activity in the IPO itself. And in an early lockup release, what I mean by that is lockups traditionally for everyone that's like kind of in the company before the IPO, they agree not to sell their shares for 180 days until after the IPO is over. It's really changed. We now negotiate what we call early releases, which are anything from releases on day one to releases based on how the stock trades over a certain period of time or after a certain quarter. So there's all kinds of variety there. But that means insiders can get out, you know, like the existing stockholders a little earlier than they used to. And that stock admin is going to have their work cut out for them, arranging all those sales, get everybody's paperwork, etc. Especially these tech companies have thousands of holders. So it's a big job. And then I think one other point I'll make on this, and then maybe we can turn to some of the Q&A, is some other things that are in the process that allow for you to have flexibility. There's been several comments that people have made about testing the waters, and I just wanted to explain what that was for anyone here that maybe isn't familiar with that concept. So the Jobs Act, which was put in place a number of years ago, allows a couple key things that companies have really utilized and have helped with this timeline issue. One of them is it allows you to confidentially submit your S1 or filing document, depending on what kind of thing you're doing, with the SEC. So you're not going out to the public and saying, hey, we're going public, until about a month before you actually price. You have to file publicly, we call it flip public, 15 days before you start your traditional roadshow and go fill up your book with investors. But it gives you tons of flexibility to go through the process, make sure it's the right timing before you flip public. The other key thing then there was testing the waters, and that allows issuers with the underwriters in kind of a very structured process to go and talk to certain large investors during that confidential process. It used to be that we only talked to investors at the roadshow, like right before you price, but now they can talk to investors and really make sure they're going out the right time, they're incorporating investor feedback. So really, really key things in the process. See, all my companies have like 60 plus investor meetings now. When these rules came out, we didn't really know if people would use them. It has been highly used and really helps with our timelines. So some things to just be aware of, keep in mind. You're not going to deal with any of those until you're actually really in the IPO process. But some things that do give us more flexibility.
Yeah, Melissa, on that, I would add on that sort of testing the waters phase. This is the prime time for the CEOs, CFOs, and others to really hone the story of what the business is. Now, the companies would have been working with all their advisors and their investment banks as well. But when you get to that point of testing the waters, you can really, you're going to get that immediate feedback as to, does this resonate? And if parts of it don't, that's when you start to see the companies change a little bit before they go out on the roadshow. Mm-hmm. It's like you're doing that little private dance before you go out and do the public dance.
Mm-hmm.
Like doing a mock quarter,
mm-hmm.
This is a great opportunity for the management team to hone in. In our process, when we talk to D&O insurance carriers, we do that after the S1 is issued. Usually comment letters have already come back, and that story, that testing the waters process is well underway. It's slightly different of meeting with a D&O underwriter than it is with investors. The main emphasis is D&O underwriters don't participate in any upside, so they're really looking for a conservative management team. But how the management, getting back to Francois's point, how the management team tells the story, and I think there's a combination of excitement for the upside, but conservatism in terms of managing this, because the IPO itself is not the marathon. That's probably the first mile. We got a long road ahead of us. So really preparing not only for the IPO, but well beyond, and building a story that allows that to happen. And investors understand what they're getting into from the early days is really, I think, an important theme.
Mm-hmm. Great. So I'll go ahead and turn to some of the Q&A questions. So feel free to drop in more questions in the chat as we're going through some of these. We'll try to address what we can. The first one that I'll do from someone anonymous is, if a company is widely profitable, what purpose does it serve to go public?
I can start with that one.
Okay.
I think, and Michael touched upon this, right? A company needs to want to make sure it does want to go public. When you go public, there's a lot of additional cost and a lot of additional effort and a lot of additional time that starts to have to be built into the company. First and foremost, one must remember, once you've gone public, and you've got to make sure you are able and capable to do quarterly reporting. And obviously you've got the Wall Street, the expectations. And if you want your stock price to be going up, then you've got to meet and beat those forecasts. And if not, then all sorts of other things can occur. So there has to be a very strong conviction that you want to go public. So then the question is, well, why would you go public even if you're wildly profitable? Some of the reasons are, like, you wish to create a liquidity event for your employees. So in a number of VC-backed type companies, you've been offering some form of stock options or restricted stock units to those individuals. And they are, for the most part, non-tradable options. They're illiquid. Taking the company public will allow those options to become liquid. And that may, and we've seen this in a number of companies, that then may make you a similar or an attractive place to work for, whether it's your engineering base or others, to come in and have that liquidity option on those options. Other reasons are that you actually do want to raise capital and you want to be part of the public market to be able to raise that additional capital. And then another part, Melissa, I would say, is that as a public company, there is sort of, if you are then viewed as having all of that governance and everything else that's embedded in the company that will allow for further investment that may come in further down the line, and allows for other activities to occur, such as like large scale M&A. So there's a number of different things, but I will go back to my opening comment, which is you've got to be convinced you want to be a public company if you go down this path. And Michael mentioned that as well.
Mm-hmm.
I'll add a couple things, but I think Francois covered it nicely. The liquidity is really key. And investing by going public and creating liquidity for the company, and ability to really efficiently raise capital depending on what industry you're in, it allows you to invest ahead of your competitors. So if you're in a highly competitive race in a particular area, technology is a great example of that. And we'll use AI as kind of the flavor of the day. Those that can invest early into their technology gives them a huge leg up in the long run. So the industry matters around this discussion, but it is important. We see technology play into all roles of the world today, whether it's manufacturing or other industries. So I think that ability to continue to invest ahead of competitors is really what gives that business a long-term viability.
Mm-hmm. Yeah, I think we really see all those reasons when we talk to companies about why go public. There is a little bit of a marketing aspect to it, a legitimacy about their business with customers, with potential employees, with others. There's ability to raise funds for growth or to buy other companies or to do things. And then the liquidity point too, that I think, Francois, you made a lot of those. There's people that have been in the company a long time, whether they're early investors, employees, that while there is an active secondary market in private companies, it's not really ever going to be what the public markets are. And so there's a lot there that at some point when all your net worth is tied up in a company that, people are going to start saying, hey, like it's time for me to be able to sell some of this and buy that house in Malibu or whatever it is for our entrepreneurs. So moving to another question. Another thing that came up while we were talking and a question is, how would one be able to validate that outside players are invested and committed to the cause? Is there a way to test it or a means of measure? How do you think about that? Michael, do you want to go with this one first?
I had one thought that might be helpful, and I'll be curious, Francois, but I'd like to think about what's the track record of that investor to begin with. Are they long-term holders? If we're talking about institutional investors, and what commitment do they have to the company long-term? Who is it? A Fidelity? Is it a Baker Brothers, to take a maybe a more niche? What does their track record say? And having, I think, asking that question and having honest conversation around it. What's their threshold for volatility? How does this fit into their investment strategy, and why do they see this as kind of a long-term play for the organization? There's certainly money when you look at the hedge fund industry that tends to go in and out of things quicker. So management team's going to know just by the type of institution they are, and that they can look at average holding times. But I think those are some of the conversations. And Francois, I'd be curious your take on that or other ideas.
Yeah, Michael, I fully agree with that. I think as well, turning it slightly from the actual investors, but to sort of the service providers that'll be along the IPO journey, and how are they invested into this thing? The only way you can really do it is by meeting the people, spending some time with the people, getting their credentials, asking them, how much they've actually spent and similar to what Michael was talking about, how much they've actually spent time understanding the business, right? And getting some references on those folks, and making sure, once again, that you can connect on the sort of, it's like, I almost want to say it's like that human level, right? I mean, the IPO journey and everything else is business, and we're all hoping for the best result from a business and financial perspective for everybody. But you've got to be able to connect on that human level. And so when I was on the other side, when I was an operator, we would just spend time. I'd meet the people and interview the people, and I would say, even in the world of Zoom and other technologies these days, if you're going to embark upon this journey, you want to try and meet the people, as my 15-year-old would say, IRL, in real life, and get to know the people you're going to be working alongside.
Yeah, I think that's true. This is such an intense and day-to-day process. And as an outside advisor, it's it's definitely the type of transaction that I love to do the most, in part because we get to know our companies and the people so well through this like extremely intense months-long process. When people ask me how to hire lawyers, I say, obviously you need people with the right experience, but then is it someone that you feel you can give that really late night call to? They're going to answer, and they're going to give you, good practical advice, and that you trust to tell them sort of the things that are going the worst with your business at whatever given time.
Maybe
big
one
personality
more.
test. Yeah.
Sorry to interrupt,
Please go ahead.
Melissa, but maybe one more point difference was point about meeting the people, and I love that IRL. I have a 16-year-old. I wonder if she'll adopt that too. But I think the point of how well do they actually know your business? And how much experience do they have? I think that is really important. The ones that really seem to understand a particular industry they have a history, and they tend to be potentially longer term investors. So I think making that connection and something, when done in person, you'll see how intuitive it is to them, and you'll be able to weigh that as part of the overall decision making process.
Oh, that's great. Maybe shifting gears a little bit for another question. How do you think about who internally should be in the tent or under the tent during the pre-IPO preparation period? Similar to M&A, like internally, who would bring in and when? There's always a risk about leaks in this process publicly, but also, within a company, we don't want to set, missed expectations in our employee base about the timing of when the IPO could go. That can create a lot of tension internally if employees are thinking it's going to be one date and then it's a year later, which has nothing to do with the company. It could be market dynamics. So how do you really think about who's that key IPO prep team, and when to maybe bring in a larger group?
Melissa, I'll jump in on this one. And I think this is an incredibly important question, by the way, right? Like a number of companies that I've worked with and companies that I've been at, where you would have like weekly or monthly all hands meetings with everybody who was in the company. And during those meetings, a lot of financial data would be shared. I mean, maybe not financials as it hits your financial gap accounting results, but maybe it's like the number of users or the number of something or other, and those always get shared, right? And then as you're going on this IPO journey, there comes a time when you've got to stop sharing that information, because then it's like, you could be called jumping the gun or whatever else, or providing information to the market that shouldn't be out there. And so you go from this point where the companies are quite transparent about everything to a point where suddenly it's not. And you have to have a communication policy around that. And it's got to be clearly explained to people why suddenly they went from something they were getting to something they don't get. And I've seen it before where if you don't do that correctly, the employee base can get very upset. I mean, when you've got an upset employee base, then they're distracted. I know we talked about it earlier. Distraction is not good for the operations of the business. So I think to the point when you're deciding who has to come under the tent and be part of this IPO process for people within the company, it has to be people that are actually working on something as it relates to that IPO journey, as it relates to that path. Mm-hmm. I would also say it has to be when you're bringing those people in under the tent, they have to fully understand that I wouldn't use the word, maybe it's not a privilege, but they have to understand that they will be shown information that they should not be and cannot share to the rest of the company. And at the same time, though, what I've also seen is it shouldn't make them feel like they are a better citizen within the company compared to someone who isn't privy to this information. And I'm saying all of this from first-hand experience, right? And so I think a strong communication policy where you explain to everybody in the company that the journey has started, and because there are certain rules, certain information will not be shared anymore, and that's just going to apply to the whole company. and that there will be certain people who are under the tent and they're not going to be sharing information, and please don't ask them to share the information. But I would say getting ahead of it, coming up with a clear policy, a transparent policy, and then making sure everyone sticks to it is critical to avoid distraction.
Yeah, and I usually do see it, and Michael, I'll let you chime in here too, as like a very cross-functional team. I think to get to an earlier point that that both you had on, people have to really work together to get the company in shape. So usually the C-suite does have general privity to it, because you're gonna have your marketing people, your HR people, legal, finance, they all play very important roles. But that layer below them, is going to be very specific to whether those individuals need to know and need to be involved in the process.
I actually have a question that may support what other people are thinking, which is, how do you think of like sales leadership, VP of sales? Should they be brought in the tent? Intuitively, I would think yes. But Francois, has that been your experience?
Yeah, I think whenever my response, Michael, is actually yes, they should be brought in under the tent at the right time, right? I think, when you're starting to think about the story and you're crafting the story about the business, and definitely when you're starting to think about how you're looking at the forecasting and the methodology there, and Melissa, you sort of spoke about it just a second ago about the interrelationship between the various different groups. If you've got something or a team or a person or an individual that has a critical piece of information that somehow will fold into either the filings themselves or the earnings calls or anything else, if they're kept out of the tent and they're not brought in at the right time, you potentially have a situation where you're going to be playing at best catch up. And also you may be dealing with emotions there where the person or the individual feels like they should have been brought in earlier and they weren't. And there's just a lot of human emotion as well. So great question, Michael. And I think the answer, we're on the same page, yes.
Yeah. So I know we're coming up on time. So thank you to both of our panelists for all the information here. Do you have any closing remarks you'd like to make as we end our panel on IPO preparedness?
I'll go first, Michael, if you don't mind. I am very much of the mindset. If you think you want to be a public company, start acting like a public company as soon as you possibly can. That's the start and end of it for me.
My theme plays right into Francois', which is start early. You're never going to be able to make up for the lost time. There's a tremendous amount of work that's required. And if you're not starting and planning and building a process out early, you're already drinking through a fire hose is going to feel much worse.
Great. Well, thank you again to Colin and the NASDAQ team for having us, and to both our panelists. It was a pleasure to talk with everyone today, and sorry we couldn't get to all the questions, but thank you for participating.
Amazing. Well, thank you, Melissa. Thank you, Francois. Thank you, Mike. Before we transition into our next panel, executing your IPO, we're going to take a quick break. So refill your coffee cups. And if you want to book a meeting with our partners, use that link in the chat box. We will be back shortly. All right. Welcome back, everyone. Next up, we have our panel of experts to share on how to execute your IPO. Friendly reminder, we're going to open up for live Q&A at the end of this panel, so please submit those questions for us at the Q&A function at the bottom of your screen throughout the presentation. Before I introduce our panelists, we want to take a quick poll just to let us know what so in the next 12 to 18 months, how many of you are thinking about listing or starting the IPO process? Are you headed in that direction? Yes, not in that time frame, or not quite yet? Let us know. This will help our panelists tune their discussion. All righty, I'm gonna let this go for another second or so. Looks like many are headed in that direction. Some are not in that time frame, and others are not quite yet. So super helpful. Thank you for participating in that poll. So without any further delay, please join me in giving a warm welcome to our special guests. Our moderator is Jack Castle, head of new listings at NASDAQ. We have Liz Beyer, who's a partner at Class V, and Tyler Sloat, CFO at Freshworks. Jack, team, welcome. We're real excited to have you. Looking forward to learning more. Over to you, Jack.
Thanks so much, Colin. Appreciate it, and great to be speaking with you all here. I guess just kind of jumping right in for everybody. Jack Castle. I sit here in San Francisco, and I head NASDAQ's IPO business for the Americas and EMEA. And so I'm fortunate to work with some incredible companies as they start that transition from the private markets to the public markets. And I'm excited to speak with Tyler and Liz today about that transition. I think you heard a lot from the first panel around the blocking and tackling that you need from an operational standpoint to really ensure that you have that foundation built for scale, but then it comes to execution. And I think it's going to be a great conversation around some of those best practices and lessons learned. So without further ado, I'm going to ask both of you to introduce yourself, give a little background on yourselves for the audience, and then we'll delve into our conversation today. So Tyler, I'm going to start with you.
All right, Jack. Hey, thanks for having me, and Liz, of course. Tyler Sloat, I'm the CFO here at Freshworks. I've been here for about 4 years. Freshworks, we are a software company really with a goal of delivering software that helps our customers delight their employees and their customers. We do this by kind of taking a fresh approach. That's the name to building and delivering, really powerful AI-enabled software that is affordable, that is really quick to implement and built for the end user. Our main products are, Freshdesk, leading customer support solution. That's our oldest product. Freshservice, which is really our fastest growing, which is an ITSM solution. And then we have sales and marketing products geared to go-to-market teams. We are a company that we have paying customers, over 60,000 paying customers in over 100 different countries. Founded about 14 years ago, and we went public in September of 2021.
Right. Thank you for that, Tyler. And Liz.
And me. I'm Liz Beyer. I am the founder and a partner of the Class 5 group, although Class V group, they all work. And it's an IPO advisory firm. I spent time as an institutional investor looking at IPOs when I was working for T. Rowe Price. I then switched over and became a banker. I did a brief stint as a venture capitalist, and then I was a project manager on a fairly interesting IPO. And eventually I thought I'd been on the buy side, the sell side, the board, and inside a company. I can take that firsthand knowledge to work with people like Tyler. As a advisor, I describe what I do as being a caddy for the management team. The spotlight is clearly on management, but I played the IPO course many times in many conditions, and to the extent that I can offer some experience-based suggestions to make the process go better, that's what we do.
Well, thank you for that. Thank you both. And Liz, obviously, you do a great job with that because we've had the opportunity to work together a few times, some very successful days. And Tyler, maybe talking about kind of successful transactions. I'm going to start with you. You've actually managed 2 software companies through successful IPOs. Most recently, Freshworks, as you mentioned, in September of 21, and then also previously Zora in 2018. So looking back, maybe just a level set for everybody, when did those companies, or we'll stick with maybe Freshworks, but when did the company and its board know it was ready for an IPO?
Yeah. So readiness, I kind of put in 2 different categories. I mean, first, you got to really want to go public, and there has to be a rationale behind it. I think for Freshworks, we were founded out of India, although we've always been a U.S. company, with not a ton of brand recognition, specifically in North America and whatnot. And one of the reasons was really for marketing. The company had always been pretty efficient, so capital wasn't like the biggest concern. It was really, hey, how can we get out there and get a little benefit from marketing? Second, in addition, we had also raised money. So, whenever you bring in private capital, those firms are going to have to get a return at some point. So then the question of when is the question. I kind of put it into 2 buckets. You have to be operational ready and execution ready. Operational ready, from a CFO's perspective, is, hey, can you close the books accurately in a considerable amount of time, or in quick fashion? I mean, are you audited? Are you essentially compliant? And can you produce the data that a company needs to be able to run? And that really is a cadence of getting the right infrastructure in and all that kind of stuff, and then going through the cadence with your team around close and accuracy with auditors. Execution ready is completely different, where that execution ready is really, when I put it, is, can you do what you say you were going to do? And from that, it's all about predictability. And it's kind of what I would say, hey, it's kind of actually easy to go public when you're operational ready. It's hard to be public. And to be public, you really have to be able to execute and be able to have predictability in your business. So for that, what we've done is we did this here, and we also did it in my prior company as well, is kind of across 10 different metrics within the organization, but really financial metrics, and some of them are on the balance sheet income statement, some of them are not. Really, from an outlook perspective, which we measure outlook at the beginning of each quarter, measuring those metrics within a band of accuracy on a percentage basis. Can we call a number at the beginning of the quarter and actually finish within that band by the end of the quarter across those 10 metrics? And if you measure this quarter over quarter for a period of time, and if you can get to the end where you actually have a grid that shows all green for several quarters in a row, then you actually might have that predictability in your business. And so that we use as a test, and I've seen others use that as a test to at least say, okay, we have some control around what we're doing and some visibility that we think we could actually go execute in being a public entity. We went through this with the board. We showed them what we thought the process would be. That process, it starts, a year in advance, as Liz knows. And by the way, Liz and I worked together at Zora for our IPO, which is fantastic. And once you feel like you have that predictability on that execution readiness, and then you can say, okay, let's go do it.
Yeah, well said. And I think we'll talk about timing a bit, but again, that's a lot of different elements that you mentioned that need to be in great shape and predictable. And Liz, maybe kind of a follow-up question for that, as you start to engage private companies thinking of going public, hopefully when they start to engage, they've got some of those, again, operational successes in place. But are there any key elements that you tend to focus on as well to ensure that this is going to be the right story that they want to show, or any long bold intent?
Yeah, first of all, shame on me for being rude and not immediately saying thank you very much for inviting me to be here. So thanks for that.
You're very welcome.
Every company's in a different position when it gets started, and a lot of it depends on what previous. Has anybody in the company been through an IPO before? It doesn't matter if they haven't. It's just a different starting place. There's no one thing. I'm mostly just going to echo what Tyler said. One, you need to know why you're doing this. It's one thing to go public. It's quite another thing to be public. And so, as I think they said on the earlier panel, the day after you pop the champagne, you got to go back to work. And there's some challenges with being public. There are some huge advantages, but there are some challenges. So you better know why You better know why you're doing it. And then again, echoing what Tyler just said, forecasting accurately. And every company going through the process gets that same message. And I would say half of them miss one of the first 2 quarters. And investors have no patience for a new company out of block. We can get to it later, but it's already risky for investors to go with an IPO when they could put money into something tried and true. So you better not let them down because they get very, very cranky. It's being able to forecast is incredibly important, knowing why you're going. And then these days, and this changes with the market, but you better have a credible story about how you're going to get to stand on your own 2 feet. 3 years ago, the money spigots were open. You could just, we're going to raise a lot of money now. We'll figure out that operating profitability thing later. Not anymore. You don't have to be profitable. You have to explain credibly how you're going to get there. And so that's probably a super important thing. We also look at the management team. There certainly are companies who swap out the CFO at the last minute. Really not advisable. Another thing for the poor CFO who has to sign all the documents and take personal liability. And so we like to see that there's been a CFO in place. And again, a CFO does not have to have done an IPO before. They just have to be ready to go through it. So I don't want to ramble on, but those are a couple things. Do you have the right management team in place? Do you know why you're going? Are you thinking about that forecasting thing? Those are all things we look at.
Yeah, well, and I think you nailed upon it. And I want to stay there for the next question as well, is just obviously there's a lot there that needs to be done and executed, but it's then how it's presented and most importantly received by the buy side or the investor community. And so the past 18 months really, and we've seen some equity market recovery over the last few weeks, especially in the broader indices with the NASDAQ up, over 40% year to date. But that said, the IPO market has really remained a bit muted this year as we look at previous years, with a good concentration of activity moving into mid to late 24. So question for you is, when it does open, as we at NASDAQ engage with several private companies, there are a variety of different ways to go public. The traditional IPO, but also the direct listings, SPAC combinations, or reverse mergers. So Tyler, we could start with you, just in your experience with Freshworks and Zora. They both elected to go public via traditional IPO. So a question for you, at the time, did you consider some of the alternative options, and maybe what are some of the key factors that you may have considered with that decision?
Yeah, at Zora, we did not. It was always going to be a traditional IPO. At Freshworks, we did talk about it and talked about mainly a direct listing. And to me, I think there could be a lot of benefits to a direct listing that we can go through, but there are also a bunch of requirements. One, capital doesn't have to be a requirement, right? So you have to be able to know that, okay, you're not going to do a capital raise through a direct listing. And so you have to be well-funded, and you have to be able to demonstrate that to the investor that you're not going to need capital. But I think more importantly for us, it was float. And so to go through a direct listing, you actually have to have a commitment from your existing investor base that a percentage of their shares are going to be, they will sell them. Because if you can't get, any float, then you won't be able to have any new investors, and then you don't actually have anything to sell, and they're not, truly public in my mind. The whole goal, is to create these long-term relationships with, really good quality investors. And a lot of those quality investors, they have to be able to buy a certain amount in order to make it interesting for them. And if there's not enough out there, they're just not going to participate. And so looking at a direct listing, like when you look at that, it could be a great alternative, but you have to have a set of investors, whether it's employees or investors, who would be willing to sell at kind of what would be perceived as an entry market price. And, that was something I don't think we were going to be able to get over.
Yeah, that makes sense. And Liz, you've actually had some significant experience managing and advising through direct listings. So would love to get your perspective on the different paths and maybe double clicking on direct listings and the benefits you saw for the companies that chose that way.
I have some strong opinions here. Happy to work with companies, whatever strategy they choose, except SPACs. I won't go near them because they just stink for the company. They're great for the sponsor, but that was a Anyway, well, let's move on from those. I think mostly direct listings are the people pitching direct listings are talking their own book, and it's about rainbows and unicorns, right? In a direct listing, for those who don't know, as Tyler just said, the company doesn't raise any money, doesn't sell any shares. It's all the previous owners. So from an institutional investor standpoint, the people at the T. Rows and the Fidelities and the Capitals, they're not putting money into the pockets of the people or into the treasury of the company that's going to grow. They're putting money into the pockets of the people who already made their money and are hitting the high road. So that's the first thing you have to get over. The second thing is they're often discussed as, oh, well, it's less expensive because you have fewer banks. Well, it starts being a less expensive process because you do have fewer banks. That means you have less research coverage. So what ends up happening is people pay the banks that are on the deal, and then they have to write fairly significant checks to other companies as extra advisors just to get them to write research. And if you're anybody, smaller than, I don't know, pick a massive name that's out there, you need that coverage, and you need that coverage from more than just the big name banks. So it doesn't end up actually being any less expensive. And the amount you pay the banks who are on the cover is slightly less than you would in a regular transaction because you're doing so much more of the work. So you get what you pay for. But I think mostly the reason I don't like them is because I think the rhetoric around them is quite insincere. For Spotify, it made a great deal of sense. Spotify was owned by the record companies, particularly care what the price was, just get it out and get the stock into the hands of professional investors. With a direct listing, generally speaking, with a traditional deal or some variations on the theme, you at least get to choose where your stock goes for that minute. You can't choose who's going to hold it, but you can say, I want Capital Group to have a lot of stock. I want T. Rowe to have a lot of stock. With a direct listing, you're throwing the deck of cards up in the air, and it's going to land where it's going to land. And the major investors generally don't feel that they can get enough stock in that transaction to hang on to it. So you end up with stocks gathered to the four winds, no investor who cares a lot. And an issue of, again, as Tyler mentioned, there were some folks who did direct listings a couple of years ago thinking, we'll do a direct listing, we'll get the price way up there, then we'll do the secondary offering to put money in the treasury. Only the stock went down. I would point to Slack as a primary example of that. So if somebody wants to do a direct listing, and you're right, Jack, I've done them if management wants to do them, but I really want to know why, and have they thought of the negatives as well as the positives, because generally direct listings benefit the people selling the stock, meaning the early investors, much more than they do the issuer, in my opinion.
Yeah, I think that's well said. And yeah, no, I appreciate it. Again, I think for everybody in this audience, we want to highlight the potential risk, right? There's, as we started with, there's a lot of work that goes into this, and you want to de-risk any deal in transaction. So going down that path, you need to understand the risk. And I think for us also heading into next year, as we looked at those big three deals in September this year with Instacart, ARM, and Klaviyo, I think one of the unique features of each one of those deals is they each had anchor or cornerstone investors. And that's not a new element to the deals, but it's something that was common across all three. And it was a blend of both institutional investors as well as strategic partners. So you had Spotify and Klaviyo, you had Pepsi and Instacart, you had Apple and Amazon, NVIDIA portion there for ARM. So I think going into next year, as we can talk to both companies as well as the advisors and specifically the investment banks, that seems to be a model that's going to be in focus going through the capital raising process next year. So I think, again, back to your point, and Tyler, you mentioned it as well, that's one of the key attributes of a traditional IPO, especially in a relatively volatile market.
If I can jump in on that for a second.
Oh, yeah.
Can I jump in on that?
Yeah.
So there hadn't been any IPOs in a while, and so they were particularly risky. When you have an environment like we've been in, sometimes you do need an anchor, which is like a good housekeeping seal. Oh, well, if Fido's in, then I'll get in. Generally speaking, what big anchor investors do, and why I'm going to disagree with you a little bit, is they crowd out everybody else. And so, yep, you need them in the beginning. It was wise of the companies to use them in September because people were unsure. But I think everybody ought to think long and hard before they allocate too much stock to 4 or 3 big names, because it just makes everyone else lose interest. So again,
I agree. I mean, I think again, the idea you have to have enough float, and so that's one thing around direct versus a regular listing. Rule of thumb: if you're listing 10% of your company, which is what we did here at Freshworks, right? And if you're going to allocate and you put somebody on the cover as like an initial, and the reality is if they are saying, "Hey, I'm going to hold that," and if that's 20% of the offering, then you only got 8% float out there, and like you actually need float. You need the capability for people to buy and sell, and if you allocate enough to one big anchor and they just hold, then you're not really solving the problem. You might have raised some money, but you're not solving truly being public, which is creating an actual market for your stock. And so those are things to consider, right? Where I agree with Liz that, hey, the investors are making money in their direct. They're going to make money anyway. They all have to distribute and sell at some point, right? It's pretty much their mandate. And so whether they're going to crush your stock later through big distributions when you thought you got through points of volatility, or if they do it at the initial offering, I don't know. As a CFO's perspective, I actually want it all done with, to be honest, and not have to deal with notes from investors. Oh, hey, by the way, we're going to go distribute another 10 million shares next week, and then you just watch your stock go down for no reason because stuff just got you just got hammered. And so I have a little bit different perspective on this because I do think for the right companies, a direct listing might actually be a pretty good option.
Yeah.
I can tell a fun story about what Tyler just mentioned, which is the venture guys selling out. When Google did its first analyst day, way back when they did it, the morning before we did the meeting, the meeting was in California, so West Coast time, that morning the stock opened way down, and it was because our venture folks chose that day to distribute their stock. So, of course, we hadn't even started the meeting yet, and people were panicking. What did they say at the meeting that caused the stock to go down? Only it wasn't us. It was our friends in the venture community who made it.
But you can't blame them, right? That's their jobs. So
that's their job.
It's going to happen.
Absolutely. Absolutely. Yeah. I'll toss in one more thing about those things, and it's clear there are pros and cons to everything, but some people choose to do them because they don't want the dilution, and so we saw companies like Roblox say, oh, we don't want to take the dilution, so we'll do a really large private round 3 months earlier at a much lower price, and then we get dilution.
I think Snowflake did the same thing, right?
Yeah, Snowflake did the same thing, and for SoFi, I think it actually made some sense because. Well, for lots of reasons to do.
But again, you have to have capital. So that's why I mean, for the right companies, it could be a right option, right? Like if you are produce a ton of cash, you have a really strong balance sheet, and you just really want to be publicly traded.
Yeah.
And you have marketing. I think the commentary on coverage is an important one. And that is one of the primary reasons to also go public and how you pick your book. But I do think that over time, if you're that quality of a company, people are going to cover you because investors need to talk to analysts, and that's how they make money. The banks do, and so they will pick you up if they think they will have enough investors who want to invest in that stock anyway. It just that takes a longer time as opposed to just immediately getting it.
Yeah. Oh, great. Love the conversation. So next topic, I guess, is, and it goes back into a bit around the VCs, a bit around the companies and the investors, is just seeing the change in valuations over the last 18 months, and really just, again, kind of the whipsaw of highs and lows. So Tyler, I'm going to start with you on this one. Maybe could you share your mindset on valuation or key metrics for both from a public and a private perspective?
Do you say start with me or with Liz? With me?
Yes.
Okay. Look, I think so. First of all, there's a reason there hasn't been many IPOs over the last year and a half. I'd say is because the market has number one is super volatile, but two multiples have come down pretty dramatically. I think that these things all trail. So private always follows public, and I think you're starting to see it now where private companies actually, for a while after the correction at the end of 2021 and all of 2022 for a lot of say companies in my space, there was a pretty considerable correction on multiples, but private companies really hadn't seen yet. And then now I think you're probably seeing those private companies are seeing that. I think that at the end of the day, the companies that are really, really solid, that can demonstrate they have the capability to grow, for a period of time in a kind of an agreeable TAM size, that they're going to get upsized valuations, and investors will still continue to place those bets. And valuations are still, even today, where there's a focus on profitability and rule of 40 and things like this, they're still going to actually weigh more to growth, always. And so companies have to consider that, right? And the reality of going public, I think it just has to do like your confidence. If you really want to get out there, is just how much dilution and how much are you going to raise? Because if you don't think the valuation is there, it still might make sense to go public. And if you actually do the numbers, maybe you just don't dilute yourself as much, right? And you just don't issue as much if you really think you can get out there and grow for a long period of time. But also, markets have to be open, and you have to feel that you're going to get a decent return for the equity that you're issuing.
And Liz, just a similar question, obviously from your seat, as you're engaging companies, executive teams, boards, thinking about the potential sensitivities and options around valuations. Maybe share a bit on your perspective on how you're advising there.
Yeah, I guess the really short answer is, for those looking at the valuations for most folks who were looking at the valuations that were available in 20 and 21, just get over it. It's done. We're not going to see 30 times forward revenues valuations on IPO companies for quite some time. There are a lot of sensitivities, including the value of employee stock and options. There's a lot of things that managements need to think about, but you need to look forward, not back. And maybe the answer is, gee, you thought you were worth X, but now the market, if you look at the, the comparable companies, you're worth X minus 20%. Maybe you do a slightly smaller deal and you get out into the market and you prove your business. And if you do that, valuations will likely rise, because investors, as Tyler said, love certainty and love performance. And you deliver that, your stock will rise. And then you do a secondary deal some months further down the road, and you can perhaps have that higher valuation. But I think we have a little bit of a challenge in that, and again, going back to why it's been a little difficult, is valuations were so high in 20 and 21. And for all the public companies, the market has corrected, and that is going to filter into the private valuations, because when you go public, you are valued against, in terms of multiples and things like, how many times revenues or EBITDA, the public companies that are already out there, how are they trading? That's your benchmark. And if the benchmark has come down, your valuation is going to come down too. As Tyler said, there'll be some that can hit perhaps the heights of before, but generally they're in AI and they have no real numbers. So get used to the fact that yesterday was yesterday, and let's look at where the market is today. And again, go back to understand why you're going. If you need the cash, or you could use the cash, raise the cash.
Yeah, it's this weird thing, right? Because the event itself, especially for a company that started as a startup and is growing, and it is so exciting, and it's just so momentous for employees, and it is human nature to now look at maybe what you have and see that there's a true market value to it, and what maybe an employee has made. That is amazing. It's hard to take away from that. But Liz kind of said earlier, it's not about the day, right? You pop the champagne, and the next day you got to go back to work. If companies are going public for the valuation they're going to get right at that point in time, that's the wrong way to think about it. It really is. If you look at a lot of study, true wealth is built, for the 5 years after IPO or the 10 years after IPO, as a company continues to execute. And that, I think, is how you have to look at it. So at the point in time, if the valuations aren't there, we both said, okay, then do a smaller offer and don't dilute yourself, and then go prove it to the market. You can always sell more stock if you go execute, and there's going to be an appetite for it. But markets are pretty fickle, especially over the last couple of years, right? They're going up and down. So trying to time evaluation or try to mark yourself at the high, yeah, it's probably not going to work.
Yeah, very good points. And Liz, I want to start with you on this one. We've seen a trend of companies starting to meet with both investors as well as analysts months, even years ahead of a potential IPO. Do you have a recommendation of the minimum number or the maximum times they should be hosting these meetings with investors or analysts? And maybe kind of a follow-up to that, are there some best practices as they think about being prepared for those meetings?
Yeah, let me go to 80,000 feet up first, which is I'm talking mostly about institutional investors as opposed to retail folks. And every day they're evaluating the various opportunities, risk versus reward. How risky is this? How much can I make on it? And so they can look at, I don't know, Microsoft or Freshworks or anything out there and say, what do I think it's going to do? Let me look at their track record. You don't really have a public track record with an IPO, with a company going public, right? Yes, you can see what their numbers are, but you don't know, to again, the point Tyler made earlier, whether they hit their internal numbers or not. You're taking more risk. So if you're taking more risk, you are going to A, demand more reward, but B, how can you minimize that risk? Well, you can't make it go away. But as a big institution, if you're going to put $100 million into a company or 50 million or whatever it is or more, the more you can understand management, the more you can understand what they're trying to do, the better off you're going to be. So if you're a big institution, you want to have a chance to talk to them, because we talk about how institutions evaluate companies going public, and it's the numbers and it's the business and it's the sustainable proprietary advantage, and all those are probably 20%, and the other 400% is who's running this thing, because every company is going to run into a challenge, and that's when you want to really. So it's my very long-winded way of saying you must meet with them 4 times, but management teams, when they're in, you're based in California, but you've got a meeting in New York, see if you can go talk to a couple of big investors. 2 reasons: 1, they get to know you. 2, you will learn from the questions that they ask. So just go have a conversation. And I guess the last thing I'll say about that is, everything doesn't have to be all shiny and perfectly formed. The big investors are very happy to talk to you before the IPO, when you mostly have it together, but go ahead and ask them questions, learn from them, and maybe you can integrate some of their views on your company into the way you present yourself. Because, silly example, but semiconductor companies are always so excited that they can do something in 2 nanometers instead of 3. And institutional investors don't care. They care, what can I do, or why will it be more profitable if I can do it in 2 or 3? So, long-winded answer, meet with them when you can. It doesn't have to be all perfect, but definitely, particularly the big guys. I was speaking with some folks at one of the bigger firms based over in Europe, and we haven't met with them at least 3 times before the IPO. I don't have to play in the IPO. I can see how they do and buy it later.
So, I'll pile on that a little bit. I actually think it is pretty important to do, quote unquote, marketing a little bit well in advance, and for a variety of reasons. One reason is creating the relationships with potential bankers and analysts, just to let them know who you are. But 2, Liz already mentioned, it's feedback, right? And it's really about getting into the institutionals who, in the very long run, you want to be the holders of your stock. And instead of going in and talking about numbers and, theoretically how big you could be, it's really talking about, what problem are you solving, and what is the size of the market that you're solving that for? And then why do you have a lot of confidence that you're going to be able to solve this problem? And who are you as a management team to go, that you would place bets behind? The reason it's important, I think, is because the actual event of going public is relatively quick. You do a testing the waters, which you get to meet with a few people and you get some real feedback, but you're flipping that pretty quick to doing, a roadshow, and then you're going public. And the time frame for investors to make a decision on whether I really want to invest in this is relatively tight. And they all have investment committees, and they have to have a thesis, and a lot of them will take a year, right, to actually go do this. And if you're trying to get that accomplished in a couple of months, it's not going to work. If you've already met with them a few times and you can show some incremental progress over 2 years or whatever it is, when you're ready to go public, they already know an idea of who you are. They have a sense, and they're going to be like, you know what? I remember these meetings, and they said they did what they said they were going to do. Wow, this actually seems like something we want to put an order in on. And so that's why I think that it actually is relatively important.
And the last thing
Yeah.
I'll toss in on that is that you don't have to show them your numbers on these early meetings.
Yeah,
It's
exactly.
much more
I
about what
said,
Tyler
don't
said.
show numbers.
Don't show
actually.
numbers.
Focus on product and market and why you could actually do really, really well.
Yeah. Well, Taylor, I want to stick on a piece you mentioned there, in addition to the investors and the analysts, but also meeting with the banks who play a significant role, obviously, in the underwriting or advising process for the direct listings. But can you share a little bit on your perspective around the process of selecting banks, kind of the timing, who you had engaged, and then why you maybe picked the banks you did?
Yeah, and I'll give a lot of kudos to Liz on this as well, going through it with Zuora, and I had the opportunity to be a controller of a company that went public in the late '90s, and so we had had a little bit of exposure to it. But I guess the first thing to remember, it's your offering, it's your company, it's your offering, it's your stock, it's your process, and so you don't have to give it to anybody. You don't have to actually be beholden to what folks say. So you have the opportunity to run that process the way you want to. You also have, full right to work with whoever you want to. And part of that work is not necessarily because they might have the best name or because, and I'll be honest, maybe because some board member has a relationship with them. It's really who's going to be truly engaged and do the work and really get in and understand the business and help you, but also be completely aligned with you. And I think that's super important to understand. As a new company, maybe with a bunch of management members who hadn't been through it before. And so picking the banks, it really is important. The first couple are, a lot of banks would hate to hear this, but the first couple are the most important. They're the ones that are going to do the majority of the work. You will get introduced to investors through others who are on your book, but there's a long tail of folks on that book that you have relationships with. That relationship is actually going to pay off more after going public as opposed to the actual IPO, because the involvement of the banks themselves, the investment banking side, is not that huge on the IPO process. But the analysts, you're kind of picking that tail for the analyst coverage and the analysts that you have relationships and and then secondarily, those analysts and even those bankers that you might really like and you love the conference that they do every year, and you really know that maybe they're a really strong M&A shop and you're going to do some M&A and you want to work with them 2 years down the road, 3 years down the road. And guess what? A lot of those bankers are super happy to be on the book. They want to take their allocation because they know it's a long-term relationship. I'd say the bigger ones are more actually, they're going to make a lot of money on the IPO itself. And so there's always a fight between left and right and, economics. And just a reminder, it's your deal. And if somebody doesn't want to work with you, you should be okay with that, right? Because they're going to haggle over this or that. You get to determine as the company what you want the economics to do. You get to determine a lot around different, well, first of all, allocation is huge. I've gotten to a point where I think, kind of allocating out about 90% and then realizing that the banks actually have a bunch of relationships with hedge funds and others and retail that you got to give them some portion, whether it's 10, 20, just let them have it, right? You need that float in your stock anyway. You want that volatility, knowing they're just going to flip it and they're doing favors to folks who trade with them. That's okay. Just make sure you own that initial part and don't be bullied. But in general, picking the actual individual as well as the name, but the individual that you're going to have a great relationship to get through the process, I think is really important.
Yeah. And Liz, I'd love to, go ahead.
I would absolutely emphasize, don't hire a logo, hire people, right? Whose head is really in the game. If you were to go today, you could get the best banker at each and every firm because nobody's that busy. When the dam opens, everybody's going to be really busy. And you would rather have, frankly, the A team from bank, I don't know, from bank R, and that doesn't relate to any bank in particular, but you'd make sure you get the A team rather than the C team from the bank that everybody wants to have. And again, they're really talented bankers at lots of places, and no bank has a monopoly on good ideas. So if you can get the A team from a logo that makes your board happy, great. But be sure to evaluate everybody with an open mind. I've done some deals that have turned down the opportunity to work with some of the names that everybody thinks of, and the deals went really well, also because those banks really wanted to prove themselves. But it's about hiring the banker, not the logo. That's thing one. Some of the banks will say, just hire us, it'll be easier, and then bring everybody else in later. It's a fine way to guarantee that nobody else really cares. And so if in some of your meetings, you're going to want different viewpoints, and each bank will try to bring each of the big banks will try to bring, 6 or 7 different bankers to each meeting. No, you know what? You can bring 3. And that way we have room for other people who might have good ideas. So
you actually break up the roadshow too, based on you got to give, certain slots and timing to different members on the book. I do I agree with Liz 100% about the individual. There is something about some of the top logos. They are important. They just tend to have a lot better access sometimes. And even maybe relationships, even not even to the investors, but to others. And great equity capital markets teams and things like that. So you should weigh a little bit to that. It also is I know a little bit, Liz, but I have seen investors question IPOs or could they not get some of the top guys, right? Top banks on those things? Did they say no? And you just don't want any of that kind of thought that you'd have to spend time talking about that at all. So there is a little bit of justification for the logo.
And I guess my answer back would be counterpoint would be, why don't you have any of those? Why don't you have either of the 2 biggest banks or the 3 biggest banks? Well, we chose this one because. You have to have a good answer. It isn't just blow them off because they're big. Because again, they're very, very good and very talented. But make sure you're going to get their attention is the real answer. So there's lots of stuff to weigh. And also, as Tyler said, and it was so spot on, if some bank says, well, gee, thanks for your offer, but we won't work for less than X. Well, if you really desperately want them, then you have to do that. But you can probably live without them and say, no, we're not paying you X. We're paying you X minus whatever. You have to build the syndicate, again, as Tyler said, that will not only work for you through the deal, because almost anyone can get a deal done. When I was at T. Rowe, I didn't care who the bank was. I cared who the management was. I cared what the numbers were. I cared what the story was. That's what mattered most. Although you're right, if they didn't have anyone, if they had a firm I'd never heard of, okay, that's different. But there are 3 names everybody goes to, but there are some other names that are pretty big too. And they've led.
I should also note it's a negotiation, right? And you got to have a little bit of thick skin. You kind of got to go into it. I don't know. I don't mind it. I actually enjoy a little bit of it. And you have to understand the other side is their livelihood. So in their defense, they are going to negotiate for as much as possible. On the argument on lead left versus lead right, it's always about, oh my God, the next deal, we won't be able to get it. And the next one, I'm like, okay, but we're talking about our deal. But the negotiation itself, you shouldn't mind a little bit of tension there. And that doesn't mean if somebody there can be a little bit of back and forth, but again, you own it. So, you should win at the end.
You own it. There will be negotiation, but you own the answer. Put together the syndicate you want. With help from an advisor.
Well, and maybe Liz, I'll stay with you on that because obviously you've got experience, going through this banker selection. You've got experience being brought in kind of both post-selection and picking up kind of that advisory work, maybe a little further in the process. When is the most opportune time to engage an advisor's firm or specifically Class 5?
I would say there's 3 answers. One are the companies that want to go slow and steady and hey, let's take an hour and a half on Friday on the 3rd Thursday of the month and talk about some portion of the process just to educate you way ahead of time. Doesn't happen much, but it's happened from time to time. 2, there's ideal, which I would describe as 6 to 9 months before you're ready to hire the bankers, because you can get so much ready before you hire the bankers, and then the process will go much more smoothly. And again, it's going to depend on who's at the firm and what they know. And then the third alternative is what I will use the technical term, the pants on fire approach. Don't love it, but it certainly happens from time to time. But ideal is 6 months prior to hiring your bankers, which probably means as much as 12 to 18 months before you're actually a public company.
I mean, I'll give another CFO perspective, right? If it's a flat fee, bring him in much earlier, right? Because why pay the the hire the same amount for a much shorter period? It's like your, kids, college advisor or whatever, bring him in freshman year as opposed to senior year if you have one fee for the whole thing. It's the same deal, right? Because if you are going to work with an advisor, you get them in earlier. They understand your business. When you get time to ideas around the S1 and your business section, everything else, they can actually help, as opposed to the pants on fire. They're not going to be able to help because they haven't really been able to dig in. So they can give ideas, but those ideas haven't really had time to really form. And so anyway, that's the CFO perspective.
No, you know what?
More value for your dollars.
I thought it is a flat fee, and I thought it would be so self-promotional to say, "Oh, hire them early." So that's why I didn't say it.
No worries.
But thank you very much. It's true,
Yeah.
right? It's a flat fee. Let them get to know you. Let me get to know you.
Absolutely. Switching gears a bit, just because it wouldn't be a conversation in 2023 if we didn't touch upon AI. And so, we're seeing this being used on several different fronts, internally, externally, in product. And so, Tyler, I might start with you from the CFO seat on your views on AI, both as you think about it internally as possibly as well as externally.
Yeah, I guess, and in context of this conversation, could be even a third thing. So internally, I'd say in my role, we use our own products, number one, and I can speak in a second how, we think AI, a lot of companies have always had AI, but now you've got, ChatGPT out there, and the advantage to be able to combine the large language models with whatever you had internally. And I think the companies who are going to execute against this, specifically on products like we sell, are really going to differentiate themselves. And I think the world is changing very, very quickly. And software companies and others who aren't building this in to let their customers take advantage of it are going to be left behind. And so I'll just say that we are building it, and we've already released some of our products, and we're really, really excited about it. Internally, it's the same thing in the way, I said, operational and execution readiness. On the operational side, the tools that we use and the systems that we use to close our books and get data and really be compliant. The expectation is that, those tools are going to evolve, and we're already using some of them, right? Automation across a whole bunch of different components of the business. Anything that we saw a lot of manual work, where even, say 5 years ago it was 100% manual, and then now you can almost automate the whole thing, whether it's AP and invoice stuff, whether it's collections things. These are all opportunities within, kind of each, what I would call the 4 pillars within a company, which you have, your quote to cash, procure to pay, hire to retire, and your corporate. There's people, systems, and process across each one of those pillars, and those operational tracks. Injecting the latest and greatest technologies is I think going to be game changing for a lot of companies. The third is around the IPO process. The thing is that what I haven't seen is, like, what are our banks going to be able to do to be able to, number one, help you automate, whether it's, I think Liz, you would say, like, get ChatGPT to write your S1, but things like that. But also, like, hey, when you're choosing a book, or not the bankers, but when you're choosing to allocate all of your shares, like, we should be able to get a lot more information now around what the history and the kind of what the behaviors of all those different investors are going to be. And there's data out there, and it's always dated, and even 13F filings and things like that right now. But you now have the capability to hopefully do really, really rapid analysis on a bunch of this stuff, which could change some of the things that you're going to make decisions on. So I don't know what it is yet, but I have a feeling that it is going to help and change things.
Yeah, I am a big fan of management having more data at the time of allocation. And I think we're definitely going to have that opportunity. There's a couple of ways to do it in the structure of the deal too, but we'll save that for another time. I think also it can be used for parts of the S1, right? Your business section, ChatGPT can't do that for you, or shouldn't do it for you. But there are other parts that I think we can condense the amount of time that gets spent just relying on tools. So it may speed the process a little bit. At the end of the day, it's not going to help you. It is, of course, going to help you in terms of having it integrated into your products. That's a story investors want to hear. In terms of the price of your deal, no, it's still about that one-on-one meeting and who are you and what's your story and let me talk to you. But I agree, companies that don't have a story as to how it will change their business, in most cases, I'm trying to think of an example where it wouldn't matter. I can't really think of one off the top of my head, but anyway, that will matter a lot. How you're using this tool to improve your business and the economics of your business.
Yeah, very much so. And I think those are both great points, because as we continue to survey the buy side, again, very topical in those investor and analyst meetings that we discussed prior. And I think it's as you mentioned, Tyler, it's the element of how are we driving efficiencies internally, and then is there, especially for software, is there that push through to efficiently create a better product for our end users, right? And we also see a lot of those AI leaders. You mentioned this earlier, Liz, around valuations and some of the already public companies that are seeing a lift from that AI component. But for those privates, they're now competing against larger incumbents that might have larger resources or even balance sheet to develop here. And so I think there's an equity or at least a story to be told around how you can compete in this market based on those efficiencies and what the growth is. Well, great. Well, I do want to save some time for Q&A, so I am going to key up one kind of last question here, and then we'll have a few more minutes to continue to get some questions from the audience. But Liz, maybe I'll start with you. What's a key takeaway or a best practice you'd like to share with the audience as they think about their potential IPO journey?
Well, the key takeaway, we both said it. It's not about going public. It's about being public. And the more prepared you are. I know I heard on other panels, yeah, do some fake conference calls and things like that. Yeah, that's nice. I would say most companies expect to do some practice conference calls and actually never get around to it because you're so busy. But anyway, so what's the key takeaway? The key takeaway is know why you're going. And I get forecast. Be absolutely sure you can forecast. There's almost nothing more important, because once you've underperformed, you're in the doghouse for quite some time. I guess the key takeaway should be hire the right advisors, but anyway.
Good plug. Tyler, same question for you.
I guess, I don't know, there's so many takeaways. So I guess in general, one, don't rush it. Do all the work ahead of time so that it does feel as seamless as possible. But when I say the work ahead of time, I mean, like, you don't try to rush to hit a market or something like that. You have to do a work backwards plan and try to set a date, but be really reasonable and just make sure you just feel like you have your internal cadence all good and everybody's aligned with what this really means. When you do that, as opposed to having an OS moment after you went public, it's like, okay, now we're public. Geez, we got to file our first Q in 30 days. You're already prepared for all of it. When you're prepared for all of it, you actually get to enjoy it a lot more, because it is such a big deal for a company that is maybe started as a startup and grown up, and you don't want to take that away. And we keep saying, oh yeah, it's just a day, but if you do it right, you get to do both. You get to just absolutely celebrate the day and the accomplishment, because it really is a milestone for a company. And then you get to go to work the next day, but you're not stressed about it because you did all the work ahead of time. You're like, hey, it's just kind of business as normal. That also means like doing the work internally, pretending you're public before you're public, right? Go through the exercise of writing your press release for a few quarters and actually kind of practicing and going through that whole thing. And when you do that, then when you feel like you get there, then it's not going to be quite as stressful.
Yeah, very well said. And I think I just add to that too, but very much echoing what you said, is start early, right? So a lot of companies are continue to scale. There might even be another private round or fundraise between now and a potential IPO. But if the sense is this is going to be kind of one of the key exit options, start this process early. I think over the last 35 minutes, we discussed all the different elements and key things to think about through this. But the earlier you get started and lay that groundwork, create those checklists, start to engage with advisors and board members, et cetera, that then makes this, one, it gives you optionality. So the market opens and the board says, hey, actually, we want to start going. We're pulling this up 6 months. You're not like, OS, as you said. Or, you've got kind of, again, that foundation laid and developed, so that when the company is at scale and the timing is right, again, you're not having to accelerate and stress. Because the other thing, and I try, both of you, and Tyler, you especially, the other catch for the operators is this is the side job, right? You're going to still have to, with all the planning, all the engagement, all of that, you're still having to close the books, manage a team, and actually execute on the operations side. And so by getting started earlier, while you still have to do this juggle, and that's across marketing and HR and general counsel, of course, it's a lot. That can be a lot on how you manage your time.
Can I put a little tiny plus two on that, which is
Yes.
a bunch of companies thought they were going to go in 2022 or 2023. And so they went through the processes that you both just discussed. Even though they didn't get out, their business is running more efficiently because they started the process and because they're thinking about the way outsiders will eventually look at them. So there's a payoff. Even if it's well in the future, you will have a stronger, healthier company if you start, as Tyler said, acting like a public company when you're
And also, I mean, it's work, right? And it costs a little bit of money, but get on file. Maybe get some comments, right? Like just go through the process. I mean, I don't know. It's work. It is a lot of work, but if you think you're that close, then just do it. And then when the market's open and you think you're ready, then you can actually just flip it.
Love it. Well, turning over to Q&A, I got a few questions here, so I'll just throw it out and we'll get you both to answer so you could figure out who goes first. So the first one was, what's the percentage of equity that we'd recommend for an offering for the IPO? I know you mentioned, Tyler, I think 10% earlier. Would you say that's pretty standard, or is there a recommended kind of range?
I think so it does depend, right? It depends on market size, capital needs. I don't know. Liz probably knows better. I think a rule of thumb is like 10%, but it depends. You do have to have float at the end. And so if you don't issue enough equity, there's not going to be enough traded. But again, it depends on how much market size, what your market cap is and what the size of that equity is. The other thing is like negotiating the lockup. And you're going to have a lot of potential leeway to negotiate that lockup depending on how the stock does and things like that will allow you to actually have more float sooner. And the traditional 6-month thing and all that, that doesn't really hold anymore. And so that's another way to really think about it. Okay, maybe it's going to be a relatively tight float for a month or two, but then if we execute or the stock execute, there'll be a lot more out there. So I do think it's not a specific rule. It's how much capital do you need? How big are we going to be? How much float's going to be out there? But rule of thumb, I don't know, Liz, 10%?
10 is a great rule of thumb. The guys who went out in September, some of them were as low as 6. It, of course, again, depends on how big you are, and the reason it matters is because the big institutions need to be able to buy enough stock to make it matter, because they're looking at a whole bunch of things and they don't have that much time. So if they can only buy some small amount of shares, even if they're up 10 times, won't move the needle on their annual performance, then they don't care. So therefore, the reason to do 10 is 10's a good number. 10, 15, obviously they did go,
You'll talk to some of the big portfolios managers, and those are the ones you want holding your stock for the long term. But if they can't get less than more than 100 million, they're not interested. It just does. It's literally a rounding error. It's just not worth it, right?
Yep.
Yeah. Well, and I think you both hit upon that well as you kind of push back on my comment around those anchor cornerstone investors with those 3 deals. Is to that point with the 6% float already kind of have pre-committed. Then as you actually go with the offering and push out some of the primary, to your point there, like the math just doesn't equate. Do I need to really buy this either in the opening auction or day one, or can I kind of pick my spots over the course of the next 6 months even, right? And going into the lockup and a lot of patient capital out there.
It's not going to be perfect, right? Because we've had situations where we've allocated what we thought was a pretty decent chunk to big institutions, but they actually flipped it because to them is like they didn't see a path to get over that minimum threshold anytime soon. They said, okay, we'll buy back in at some point when we feel that we could actually make a position and that you've proven yourselves over time. So it kind of like it's not going to be a perfect science no matter what you think it's going to be going in.
Yeah. One last question, and then we'll be out of time ourselves. But interesting one came in. Just the decision companies make, and Liz, maybe I'll start with you, whether to hire an advisor or to manage this in-house and specifically through an IRO or maybe a person that's going to cover some of that function for the business.
Yeah, I think that the overall task is bigger than the IRO. The IRO is incredibly important, but is the IRO going to make sure that the finance department has delivered the information it needs on time, or Are they going to be able to tell PR or comms how to behave? No, I think it needs to be someone who's not, often it's the CFO delegating to someone within his or her organization. Obviously, I believe it's important to bring in somebody with vast experience from the outside, because you've just seen a lot of stuff and every company's different and you can pull from the various, anyway. I don't think the IRO should be the project manager. Many companies, and we heard this on the last panel, do pick someone to be the project manager, but that's the job while they're there. Then you just need to figure out what they're going to do later. And every so often you've got someone who's a very experienced IRO. I'm thinking of Freshworks, and he could probably be super helpful. But generally speaking, it's so cross-functional that to have one person from one function running it all can get a little complicated. So I think you hire an outside advisor.
Yeah.
There's a massive legal component. Well, there's a massive legal component too, right? So I think it's really important to have a really great GC. I've had the blessing of both companies having that partner, but also a great outside firm that knows, how to essentially engage with the SEC and go through that process. So don't underestimate that as well. The PMO side, I think it has everything to do with what experience you have within the organization. Liz just said it. If you have a really, strong folks in some areas, I don't think you need it. I mean, it just depends, right? But if it's going to be kind of chaos, then yeah, you should probably hire somebody to. And I'm not even talking about outside advisor. I'm talking about internal, just managing and coordinating, right? The outside advisor, props to Liz. It can be very value add.
Yeah, and I'd say that just. Oh, sorry. No, go ahead, Liz.
I was going to say sometimes it's nice to have an outside advisor to be bad cop, right? And there are moments when you need a bad cop.
Yeah, and I'd say as we look generally across kind of the different cohorts of scale businesses that have gone public, I don't think we talked to any CFO specifically, let alone kind of executive team, that was disappointed by having that additional support, whether they were leading or augmenting kind of the experiences of the executive team. It always was valuable. There was an ROI on that, especially again, given everything that's going on, regardless of even experience for the management team. It seems to be a great attribute for advisory firms and through this very large and very once in a lifetime, twice for Tyler, but opportunity to go public. So with that, our time is up today. I want to sincerely thank you both, Tyler and Liz, for the conversation, the stories, the perspective, and cheers to a great rest of the year.
Yeah, Jack, thanks again for having us, Colin. Thanks for emceeing over there. And thanks to the whole NASDAQ team.
What he said. Thanks so much.
Well, thank you, Jack, for leading such a great conversation. Thank you, Liz and Tyler, for sharing your experiences. Appreciate you all. And if you want to take a look and book a call with our speakers, we're sharing a link in the chat, so you can raise your hand there. And before we transition into our last session of the day, achieving success as a new public company, please take this time. We're going to take a quick break and we'll return shortly. See you all in a bit. All right, all right. Welcome back to our final panel of the day, Life as a Public Company. Friendly reminder, we're going to open up for live Q&A at the end of this panel, so please submit those questions in the Q&A function at the bottom of your screen throughout our discussion. We hope the information provided by our experts so far is timely and valuable, so we look forward to staying in touch as your growth continues. If you're interested in booking a meeting with any of our partners, please use that link in the chat. Okay, now let's move on to our final panel. Without any further delay, please join me in giving a warm welcome to our guests. Our moderator is Shivani Sapori, who's a partner at KPMG and also a board member at the NASDAQ Entrepreneurial Center. We've got Shannon DeLahey, partner at Wilson Sonsini. We have, welcoming back from the first panel, Francois Chadwick, partner at KPMG. And we have Priya Huskins, Senior Vice President at Woodruff Sawyer. Welcome, everyone. Looking forward to this discussion. And Shivani, over to you.
Hi, everyone. Thank you so much, Colin, for the introduction. Appreciate it. So I think we can jump right in. We've been able to get through the intros, but I will maybe give each person a little bit of chance to talk a little bit about themselves and what they're here to speak about. For a little bit of background, my name is Shivani Sapori. I am a partner in our KPMG Silicon Valley practice. I'm also the leader of our private enterprise group. So I work mostly with private companies, taking them through IPOs and thereafter. So I'll turn it over to Shannon maybe, and we'll start with you with the intros.
Hi, everyone. I'm Shannon DeLahey. I'm a partner in the Palo Alto office of Wilson Sonsini. I split my time 50-50 IPOs and then public company representation post-IPO. So lately it's been about 100% public company work, but in earlier years, that's really where I tend to focus. So the transition to being a newly public company is something that I'm intimately familiar with and happy to chat with all of you about.
Francois, let's turn it over to you.
Hi there. For those that may not have been in the first presentation, Francois Chadwick. I'm a partner at KPMG. Just returned back, having spent 9 years on the other side of the table at various roles at Uber, taking it public, including up to the CFO role. And I was CFO of another couple of companies, taking another one public through a de-SPAC. Now back and enjoying myself at KPMG.
Thanks, Priya.
So hello, everybody. I am Priya Huskins. I'm a partner at Woodruff Sawyer. We're a full-service commercial insurance brokerage headed in sunny San Francisco, servicing clients worldwide. We broker all lines of commercial insurance, including employee benefits. I'm an expert in D&O insurance, and Woodruff Sawyer is the market leader when it comes to D&O insurance for IPO companies. I am a corporate securities attorney by training, transitioned to a business role, of course. And in addition to serving on the board of Woodruff Sawyer and one other private company, I serve on the board of 2 public companies. Great to be here today.
Great. So I do think we've got an awesome panel here, and the day has been great so far, lots of different topics. Now I think we'll take the stage of, we've been through an IPO, we're now a public company. It's exciting, it's a new phase for companies to be in. What do we really need to be thinking about? So maybe the place I'll start with is just the current environment. To date, we've seen a pretty tumultuous IPO market. A number of the companies that had gone public a few years ago haven't been able to either match their IPO price or kind of pop up above that. Can each of you maybe take the first pass at talking about what is one of the biggest impacts you've seen this market have on your newly public companies? And maybe, Francois, since you're off mute, we can start with you and then we'll popcorn to the rest of the team.
Yeah, thank you for that. I think one of the things, and this has sort of been a bit of a theme through the first and the second panel and continuing in through this one, is, when you're going on that path through the IPO, you're planning, you're getting everybody involved, and then you're going through the actual listing. And then to this part where it's post-listing, is you have to be ready. And you've got to make sure that you've got everything in place to be able to, like I say, I've said this before, close the books, be able to forecast, meet and beat. This is the things the street is looking for. And I think this sort of, you call it the tumultuous window. I think what people are now expecting is to have companies that are buttoned up. And so anything and everything that can be done to make sure that that occurs is now the critical thing. And I can talk a little bit more about some of the specifics, but I think it's a matter of, excuse me, making sure that you have everything, like I said, buttoned up and ready to go.
Shannon or Priya, other things to add from your perspective?
Sure, I'm happy to go next. I would say that newly public companies that I've worked with and just across the tech sector in particular are laser focused right now on the things that investors care most about, which right now seems to be profitability combined with growth. And so that's one of the biggest changes I would say in the past few years, is just a laser focus on achieving GAAP profitability, and really focusing on, you know, other types of metrics like Rule of 40, margin, revenue, growth. So that has, I think, changed some of the ways in which our newly public companies are operating and engaging on a whole variety of levels. So something to keep in mind, because that's where investors' minds are. And then just a second thing to note is, you know, usually when a company goes public, you see pretty quickly thereafter big follow-on offerings, debt issuances, and, you know, the first couple of years, opportunistic debt, debt issuances. And we're not really seeing that. They're essentially, you know, the capital markets are essentially almost closed. So there aren't these big follow-on offerings. You know, not a lot of convertible debt offerings right now. Some high yield, you know, deals, but all at coupons that have been higher than in the past. So I think for companies preparing to go public, you know, you sort of have to think about your cash, think about your financing options in the years following an IPO, and those same opportunities are just not there where we had traditionally seen those in earlier years, just, you know, 5 years ago.
You know, what I would add is just the observation that delay has been really hard. And I know this is about after being public, but the reality is there are going to be a lot of people on this webinar where they're still in that delay mode and they're learning. And things have gone from, yay, the gift of time, to I've been in the crouched and ready to run position for so long, I'm cramping up, right? And so talent is impatient. And companies, even companies that finally got through the IPO window, they've lost talent, and they've lost some patience from their people. And then what Shannon is talking about is such a big issue. We're not able to raise money at the cadence and pace that we would normally expect for a new public company. So all of those things come together to form an environment that I think is really tough for new public companies. And it's also a cautionary tale, right? Part of being public is being thoughtful about getting ready to pivot, thinking about how you're lining up your funding if windows close. That's where we are now. And just on that last point, since I'm the risk person, we are seeing a lot of our companies leaning on their already in investors to bridge this time. And just a note of caution that can be extremely supportive, or it can actually be a conflicted transaction that other shareholders get worried about. And so just having some, like, by all means, being innovative and clever, if not downright cunning about how you think about your cash and how you're raising money is great. And just don't forget to talk to Shannon or your outside attorney about where clever becomes conflicted, because the whole point is raising the money, not using it to pay the plaintiff's bar.
I think that's
sorry, Shivani, I was going to just jump on Shannon's comments as well. You know, having been the CFO, you're getting asked to, like, make sure you hit your revenue targets, show your path to profitability, be able to maintain your cash balances, and meet all these other metrics that the market is asking for. And the market, as I'm using your word here as well, Shivani, is the tumultuous nature of the market. And so you're being forced to have to make decisions which are like slightly changed than you would have done in the past. But in the past, for example, you may have spent money in, say, the R&D space with like a 5-year window of looking for that rate of return. Now you're having to bring that window shorter. So it's like, what is that rate of return going to look like in a 12 to 18 month window? And what's that level of spend, and how much commitment are you going to put to that spend? But there's always going to be that question, what does that mean for the future? Are you having to do something now that may have an impact in the future, a negative impact in the future, if you're having to play catch up? But I think the market is now looking to favor those shorter term results by making sure people are spreading the dollar and not burning as much cash as may have been done in the past.
Thanks everyone for those feedback points. I think that's a good way to kind of frame the discussion for the current environment. I do want to turn over to Shannon to talk a little bit about the regulatory environment, kind of compound a bunch of things this year. The SEC's come out with a number of new regulations for cyber. There's been talks about ESG. We've got new rules on clawback provisions for pay for performance, a number of things that came through the pipe this year. Shannon, do you mind talking a little bit about what you're seeing in the regulatory environment and how companies should be thinking about reacting to that?
Sure. So I mean, after you've successfully completed your IPO, of course, one of the very fun things to look forward to is SEC regulation and the myriad of rules that you need to comply with. That's what we're here for, to help newly public companies work through all of that. And this year in particular has been just a bumper crop year in terms of SEC regs. And so a lot of newly public companies and just, even frankly, very large, big public companies are struggling with how to implement all of these new rules at the pace that they're coming through the SEC. So I would say some of the top highlights, cyber is key because the new cybersecurity rules that the SEC put into place are actually going into effect, I believe, next week. 8Ks will now be due when you have a material cybersecurity incident. For 10Ks that will be filed in early 2024, we'll see a lot more disclosure about the board's oversight and risk management of cybersecurity practices at companies. So that, that's been a big focus. Climate, the SEC has kicked that until next year, but there are lots of climate regs, both from the state of California and in Europe. There's one regulation in California that's even due on January 1st of this year. So certainly there's the movement in the climate space. Clawback rules, those were required to be adopted by December 1st. So all of our existing public company clients have those in place. Essentially, if a public company has a restatement of its financial statements, it's required to think about whether there were any incentive-based compensation awards that were tied to the financial metrics in the financials that have been restated. And so if you had a revenue target and then you restated your financials and revenue was lower, then you have to claw back that additional compensation paid to executives. And so that's now in effect. Those are sort of the big highlights, but I think just, depending on which year your company goes public, you can expect to have any number of new SEC rules. And so that landscape is always changing. The one thing that is a constant, and this is really coming through in the SEC enforcement cases recently, are the SEC's focus on internal controls, disclosure controls, and procedures. And so as a company thinking about going public and as a newly public company, making sure that you have those controls in place is of the utmost importance. We're seeing the SEC go after companies for just, not following the processes that they've set up internally to do things. And so just, I guess, taking cyber as an example because it's relevant. So in a company's 10K, it has to describe now the board's process for oversight of cybersecurity risks. And so companies are trying to be very careful in terms of, what they say and how much they say. Like, you want to have a policy in place that complies with the rules and that helps you actually assess your risk, but you don't want to have a policy that's so burdensome and cumbersome that then you don't comply with it, because that would be the worst result, is that you have a cyber incident and you as a public company didn't have the ability to actually follow your own process, because that's ripe then for the SEC to come in and say you didn't even have the right controls in place. So striking that right balance between having enough policies to cover you but not having them be so unwieldy that you can't actually comply with them is, I think, a key challenge for all companies, and especially newly public companies.
Thanks. And Shannon, since you mentioned controls, maybe I'll kick it over to Francois. At KPMG, we obviously do work with a lot of companies in that getting ready for control environment phase, pre and post IPO. Can you talk a little bit about how you see the control environment and what companies should be doing to prepare for all the disclosure controls and the requirements that the SEC is asking of public companies.
Yeah. When we start talking about controls, Shivani, I think there's sort of the two sets. There's like controls, internal controls that I would recommend any company, even as it's going through and becoming ready to be public, is building in place these internal controls to operate at the most efficient manner possible. And that could be anything such as access controls to IT systems and things like that. Those are the things that I think a company, as it's just doing like the least regret, best possible things possible, should be doing that. But then once you become public, dependent upon the size of your business and when you hit certain thresholds, you are going to have to start reporting on the Sarbanes-Oxley and those SOX controls as well, and issuing other reports. And I found that your 404 reports, and where this gets very, very, very interesting, Shivani, I'll tell you this, is like, as the CFO and then and a CEO, they've got to start signing off on those reports as well. And so I would say, like, building on what Shannon was saying, you've got this whole set of SEC rules that just continue to grow and will continue to add more demands within a company to be transparent, to be able to report on things, and not just report on things, but report on things in a very, very swift fashion. Shannon mentioned the cybersecurity rules. You've got 4 days to report something to the SEC for something that's material, right? So building a process, building a control, and making sure that all the relevant people within the company know, that relevant people in the company know about it. But to Shannon's point as well, making sure that it is actually something that the company can execute on, that it's something the company can do. You should never ever build a control that is like sounds great and looks great on paper, but you just cannot operate. It just won't work. And I think, you know, Priya, I'm sure you can jump on some of this as well, because this has got implications all over the place for D&O.
Yeah, I think that's a great segue over to Priya. You can talk a little bit about the focus on insurance and how that all relates. That'd be fantastic.
Yeah. So, I mean, first of all, we all hope that before a company goes public, they have done the work required to upgrade their overall enterprise risk management process. And that definitely includes insurance. It includes non-insurance things. And, you know, I get it. As companies grow and as they scale, the enterprise risk part of it can be this kind of unholy mushroom hodgepodge that just grew up in the dark. And it's very uncomfortable to start unwinding that and putting things in place when you're already public. It's not ideal. And in general, you want the entire risk management program, including insurance, for things beyond D&O, and I'll get to D&O, to be ready for public company scrutiny. And so taking that time to up-level how you approach these things in a lot of cases, and, you know, no shade here, companies chose who's doing the insurance for them, for example, because their brother-in-law seems super nice. And that is actually okay in the beginning, but as you're up-leveling to go public, now you need things like real platform expertise, resources, data, all those things, because now we get to the other side of it. Francois has helped you with control. Shannon has advised you on how to disclose, and none of us are perfect. And so that's a terrible position for management to be in, and the board as well, if they feel like, you know, unless I'm perfect, I'm personally exposed. So instead, hopefully at least a year or so in advance of going public, putting in that safety net, which is really the best way to think about insurance, right? It's this wonderful combination of please try really hard so you get better terms and conditions or insurance at all, coupled with the way, you know, carriers do understand mistakes are made. And that's actually why we want the insurance in the first place. I will also say, as you are up-leveling and scaling, one of the things people sometimes forget is as you get bigger and as you get more complex and as the stakes are higher, the cost of insurance also goes up. And so this is, again, where a year or so in advance, and then with some visibility after you go public, you want to start talking about what's your philosophy around the purchase of things like insurance, D&O or otherwise, so that you can budget for it. a play, since Shannon brought up cyber, let me just also say the intersection of cyber and being a public company and then personal exposure for a CFO or a CEO or the board, or how about CISOs, like that's very live and it's happening right now. And it's something to be thoughtful of as you go through the process. How is everybody feeling comfortable about making decisions and moving as quickly as you need to in a public company environment? The CISO question right now is quite fraught. A lot of CISOs aren't officers, so they're not maybe naturally on the D&O policy as it's typically understood. But when you work with a really good set of advisors, including a insurance broker that does this a lot, you can get those answers very quickly. And for those who are wondering, in the case of CISOs for public companies, they're typically automatically covered for securities claims. And I'm talking to you, those people who are worried about the Solera CISO who's been charged by the SEC. Shivani, most people, when they ask about, though, D&O insurance, it's what do you do when you're trying to go public? And we just put in the chat a guide to D&O insurance for IPO companies. The thing I would say is the win is having a great process that starts early across all lines of insurance and being mindful what changes. Cyber insurance just needs to be good. It doesn't particularly change because you're going public. D&O insurance obviously changes in a very fundamental way. So again, getting in front of it, having the budget for it, and taking a beat to understand what is covered and not covered so that directors and officers feel comfortable making decisions at the pace they have to as a public company. That tends to be the win.
Great. Thanks so much for that, Priya. Maybe I'll turn it back over to you, Francois. In your role as a CFO, what should CFOs be thinking about in their first year after going public? Like, what are some of the key things that, you just took your company out, you're now in the public view on a very regular basis? What would be your top hit list of items to consider?
It's all around the story. It's about how you're positioning the company to the street, how you're positioning any events that are occurring through the year, good and bad. You've got to be prepared for all of them. And also making sure that as you're building out those forecasts, that the story is backing up those forecasts so that as you go through your quarterly earnings, what everyone wants to do is that, you have to meet and beat. If you're going out there and you're having a quarter that, for whatever reason, is not a meet and beat, especially in that first year, it's going to be very, very tough. So making sure that you've got the internal functionality to be able to predict and do those forecasts and make sure you feel very comfortable with those forecasts and how those forecasts are made up. And then being able to craft the story around it, and then working with, through investor relations and working with the bank and the analysts and making sure that they're on board, they're understanding what the business is doing, what the business is looking to do, and that you're bringing them all along on the journey. That's very, very important in this first year. And if somehow that starts to slip, it can be quite difficult to pull it back and reposition it. So I would say that first year as a CFO, especially when you're looking externally, those are some of the critical things.
Thanks, Francois. Shannon or Priya, anything else to add to that? If you were advising a new CFO as a public company in your respective spaces, anything to keep top of mind for that first year out the gate?
I think Francois said it really well. At the end of the day, it all comes down to making the company run and making sure that you've got the controls so that you're not missing things. It's a huge area of, I would say, disappointment when it goes poorly. But I would just remind people, there's a difference between the street and personal liability. And in the first instance, it's all about making sure the street is happy and you're executing on what you had promised to do, which I feel like is thematically what Francois was saying.
Priya, I don't have anything to add to what Francois and Priya said there.
Well, maybe we'll take a step back and think about the company even broader and start thinking about like the board roles. And I know a lot of thought goes into board composition leading up to an IPO, but that is another area that companies need to be thinking about as the companies grow, right? You might have to pivot how your board is structured. Maybe you're adding new members, new SEC regulations may prompt the need to like fill out the board roles. Maybe we'll start with you, Shannon. Can you talk a little bit about how to think about like the right set of individuals on your board as a public company?
Yeah, sure. Happy to. I think, I'm not sure if some of this was already covered in the morning sessions about how to think about your board pre-IPO. Actually, Shivani, was this covered in detail? I can go into a little bit more detail here if not, but otherwise happy to hit it just as a public company.
I do think they touched on the pre-IPO phase, so if you can focus a little bit more on like once you're a public company growing, what things to consider.
Got it. So maybe the first thing I'll say is pre-IPO, given all of the, regulations in terms of your independent directors and the like, you do see private companies kind of rushing out to bring in, independent board members, so sometimes very prominent board members to give the company, that cachet during the IPO process. I would usually reassess how things are going in the boardroom as a newly public company, because sometimes the board looks great on paper, but just doesn't really have the right chemistry when you're kind of pulling together people from different sectors, different areas of expertise. And you see that quite frequently. And I think it's most important to focus on having a board that actually works for your company and that, management interacts with well. So I think you should constantly be evaluating the, efficacy of the board that you put into place. And so that's just from a more of a personality standpoint and contribution standpoint and engagement standpoint, not so much on the legal front. And then Shivani's right. I mean, there could always be new regulations in terms of, diversity of board members and the like. You also do see sometimes directors that are affiliated with big investors. As those investors sell down their stakes, then board positions open up. And so that's when we typically see new board members added as a public company. But I think I just keep coming back to finding the right fit. I think is really critical for newly public companies as they're finding their way in this world.
What I would add is just the observation that what got you here very often won't get you to the next level. And so when people are going through the IPO chute, totally agree with Shannon's point. Sometimes you've got a named board member who is like super fancy and kind of a celebrity and just has not one clue on what to do with a new public company. And maybe that you wanted the name, but let's do an evaluation. Let's reassess. My guess is if no one else is enjoying it, neither is the celebrity board member. But I make this joke all the time. It's kind of easier to divorce than get off a board. So we got to have the ability to have real conversations about this. And so I know that everybody talks about the importance of the audit committee chair as a cornerstone board member, and I certainly don't disagree with that. I think people can underestimate the importance of the skill of the nominating and governance committee chair, because navigating these issues, like suddenly finding out that your board is just way too muscular for the reality of what the company looks like today, you've got to have somebody who can navigate those issues. This is going to shock people. Sometimes there are some egos on boards, so the navigation is pretty tough. So that's one observation. I'd also say that a lot of public companies, is the window open? Is it open? It's not open. It's not. Okay, let's go. Right. So you may not have been, like Shannon tried really hard to get everybody to do great governance. It may not actually be the absolute best governance. And so just being willing to say, and to calibrate to size, like a new public company has no business having the level of corporate governance at the board level or otherwise that a huge mature public company does. But it's not okay to be unwilling to engage in incremental change and up-leveling over time. And if you want serious board members, those board members need to see you do that. So just because somebody's not a celebrity board member doesn't mean that they're delighted to be cavalier with their personal reputation. So it is a little bit of both. And the thing I often do say is the corporate governance doesn't matter until it's literally the only thing that matters. And thank you so much. Every news story, like once a quarter to remind us about that. And so making sure that as you're thinking about your board, you've made good decisions about how you're protecting them, which is, of course, indemnification agreements, D&O insurance, but it's also what are the parts of the corporate governance that are also the fire sprinkler of risk / help a board member just coming into the situation do a good job. So that recruiting, you can see why, after all of these words, you can see why one of my big points is the skill of the nominating and governance committee chair for a new public company is really important.
Yeah, I would just add to that, Priya, if you have a joint CEO chairman, which a lot of founder-led companies do, then also a lead independent director can be really useful. The number of times that we've had investors call upon, I want to speak to the lead independent, or I want to speak to the chair of NomGov. It happens pretty frequently. So I agree that that person serving that role can add real value to the company. Also, audit committees are completely overwhelmed. There is so much falling on audit committees these days. Everything that seems to be of importance, not, except for some of the like ESG stuff, but cyber, okay, that's audit, this is the audit, that's audit. So the audit committee chair can't do everything.
Although they're always asked to, I feel like.
Yeah.
Yeah, Shivani, the only other thing I would add to this, which is building on what Priya and Shannon said, is when we were building out the boards, from being pre-public into public, and you're bringing on new board members, what we did, and I find this to be very good and best practice, we built a book of like total information about the company. So it was like a set of data. It included financials and the org charts and all sorts of different things. And it actually turned into a living thing that we sat down with each new board member and helped them and walked them through it. And not only did that help them get up to speed on the business itself, but to Priya's comment about personalities, it also meant that every new board member understood that they'd all got the same sort of training and there was nothing special that one person got over another person and things like that. And it really helped sort of level set the table as you were bringing in all those new board members.
It's really thoughtful onboarding, really thoughtful, which is, again, something that you don't always see with a new public company. So that's a fantastic suggestion.
Okay. So Shannon, turn it back over to you for a second. As a corporate securities lawyer, you are involved with a lot of companies and you see a lot of things before and after an IPO. Do you have any practical suggestions on what not to do as a new public company? I know we talked a lot of what to do, but like, what are some of the things that you definitely would recommend your clients stay clear of?
Well, don't violate the law. That would be number one. But no, let me just speaking more practically. I think that this just brings it back to what Francois said at the very beginning. To be successful as a newly public company, you have to have solid business fundamentals. Investors are looking for you to basically have, 4 to 8 very awesome quarters right after going public. They'll be disappointed if that's not the case. So I would, say just don't go public too early, because if the business is not ready, you're going to have a host of challenges in that post IPO year. But let's just say that, you think the business was ready and you had, years of solid fundamentals before going public, and you have a stumble in your first year. I think, a key piece of advice I would give to management is just, be open to being more full kimono than you're used to being as a private company, because now you have disclosure obligations. So if you have a bad quarter, you will very likely get a stock drop lawsuit. And the only thing that can save you in that situation is good disclosure. And so I've advised plenty of newly public companies that have had very challenging quarters, especially in the past couple of years due to macroeconomic conditions. I mean, some companies that businesses just essentially fell out from underneath them, and were all sued. But the companies that I think will do the best in those, litigation cases are the ones that had really, really good disclosure about exactly what happened, identifying trends as early as you're seeing them so that investors are not surprised, making sure that those trends are flagged in risk factors with very specific examples. The SEC really has started cracking down on companies that are giving risk factors that say things like, this may happen to us. It's like, well, if you've seen it happen, you have to change that may to this has happened and it may continue to happen. You should give very specific examples where you're seeing things happen. And I understand that companies often don't want to say those things, but that is like your defense in a litigation. And so I think that tension of not wanting to say things, but needing to say things is sort of a key challenge for newly public companies. And that's what we'd like to, impress upon management, is to try to reframe your way of thinking. Disclosure isn't bad. Disclosure is protective.
Shivani, if I could add to that, and there's a great question in the Q&A that you probably want to ask Francois. So while I completely agree with everything Shannon said, there's a little asterisk that's not very fun. So be prepared to be, as Shannon said, open kimono. You have to tell the street things, even if it's not, great news. You can't just do happy talk to the street. One of the challenges that we see our clients run into all the time, though, is there's a difference between being transparent with the street after you've gathered your information versus a lot of sort of very loose talk within the company, because that's what you've always been doing. One of the hardest transitions in my experience for companies going from private to public is going from, we share things freely with our employees. In fact, if you want to see how the sales are developing, click this link, right? And just so much information sloshing around a company. That's why some of us like being at private companies, right? You know things and you're kind of in the mix. And that becomes a problem as something happens and Shannon is advising a company and they're trying to develop what's going on. Having to lock down that information, it does change people try their very best, but at the end of the day, even the employees will ultimately learn they don't want all that information just swirling around in the company. And so I do think that can be a real shift for founders and for leaders and for their employees. And just to mention it, that is in some sense the cost of having access to the public companies and the public capital markets and all of that, but it's real. And Shannon can't do her job and she can't do her job well if there are like all these various narratives and, God bless me, instant messaging and emails that contradict what the actual truth is, because it will look bad in retrospect.
That's a really good point, Priya. We have, I think it's, reframing the message of you can be open, but the timing of your communications needs to change. Like, let's have that all hands meeting on the heels of earnings, not, 2 weeks before earnings or right at the end of the month or, year when you know your results. It's also like a practical challenge, because I've tried to help a lot of companies just think through just like administratively, like how do you turn off Salesforce access for certain subsets? And I have like newly public companies that are 5 years into being public that still haven't quite figured out how to prevent access within the organization to key folks. So it'll never be perfect, I guess, is the answer, but you can certainly sort of control the tone at the top in terms of CEO messaging to employees when you hold your all hands meetings, the type of information that you share, all of that is really critical, because your employees, even though, you might think they're under, they're all under NDA, like with the company, like what's the harm? I mean, they're also your shareholders and they also can trade on that information. So that's what you're trying to create, a culture of compliance with your insider trading policy. And so giving people a bunch of information when the market doesn't have it just isn't good from a culture of compliance, standpoint. Even if it's not technically not allowed, it's just not wise to do it.
And I think Shannon and Priya, to that point, you've got to. What I found is you're going to need to task somebody internally with those communication challenges, because you're not just talking about one or two communications, you're actually talking a lot about change management as well. So it's not as though you can just go out once and say, hey, you know, everything you used to get in these weekly all hands meetings, you're not going to get anymore, right? Because if you just said that, and I've seen this, you say that, then suddenly there's disruption in the employee workforce. Like, well, why not? And what does that mean for me? And why is that person over there? Why can they still have access to it or whatever else? So it's a series of communications, taking advice from the likes of the people on this call, together with somebody who has, like, whether it's a PMO or a change owner within the company, to help affect that sort of almost, I don't want to say day in, day out, but it doesn't happen overnight. It's, you know, and Shannon, you mentioned the word, you know, it's part of the culture. The culture has to shift, and culture does not change overnight.
These are all really good points. Priya, you had mentioned cost of being a public company, and I think cost can be in two different ways. It's like actual financial cost, but there's also just the time cost, so the administrative burden that companies face with being a public company. I guess from your perspective, Priya, we'll start with you. That I'd like to go around the group. If you can talk about how companies should be thinking about the cost changes over the life cycle of a company once they're a public entity, I think that would be helpful for the group.
Sure. And I appreciate your starting with me. And I'll, of course, talk about insurance because that's what I do. So Francois and Shannon will certainly talk about other areas of cost. What I really appreciate is the opportunity to say the following. It is no longer the case that D&O insurance and its cost is one of the things that might absolutely stop you in your tracks when it comes time to go public. We are coming off a market that wasn't just hard, it was catastrophic. And hard market for insurance people is defined not as, boy, this really is unpleasant. It's defined as an inability to get capacity sometimes at any cost. And that was a terrible situation. So we saw, when you look at what happened with the cost of insurance from 2013 through 2021, like, I mean, I think most of our clients would like to see a hockey stick like that. It was awful. I mean, it was terrible. And so even the ability to plan for companies trying to go public, like let's say you're planning to go in Q1 and you delay to Q4, it wasn't always clear that you could hold the price in place in an environment where it's going up. We have a very different environment now, so much capacity in the market. There are other dynamics that mean the following. For now, your D&O insurance, that's not going to stop you from going public. But as a company, you will want to get better about thinking about the full budget, right? All of these things have a cycle. So, you know, where is the property market? Where is the cyber market? And depending on what you do for a living, these can be very significant costs. But at least let me finish here with the good news. While D&O insurance is now not free, it is so much better and more predictable than it was when we were having the same conversation in, say, 20 and 21.
Thanks for that, Priya. Maybe, Francois, we'll turn it over to you to talk about cost from your perspective, and that can be time cost or cost in general financially.
Yeah. And I just say this, Giovanni, whenever we talk about cost, one must always remember there's a reason why companies go public. And so there's all of the benefits of being a public company. And we spoke about that on one of the prior panels. But when you think about the cost, especially when you're thinking about it from the finance standpoint, you know, it's you have to report on a quarterly basis. You cannot miss that anymore, right? And so you just cannot miss it. It has to be done, and it has to be done. Your financials have to be complete and accurate. So you've got to make sure that you've got all the right technology, the process, the systems, and the controls in place. And that's like, you can start and you've got to build into them, but as the company continues to grow, you've got to continue to build into that. And, you know, as you're thinking about that, as I mentioned, technology, systems, process, people, you've got to get that blend correct. And that's a constantly evolving thing. You can't miss a quarter, but it's going to cost as you continue to build into that. And you're going to add more technology into your finance system. You're going to maybe need more people. If you're a company that's looking to make acquisitions, you're an acquisitive company, you've got to be able to still make sure you close your quotas whilst you're doing your M&A activity or other growth items. So there's going to be these additional costs. And of course, and I'm sure Shannon's going to talk about this as well, but obviously once you're public, there's a whole host of people who start to crawl out of the woodwork and start to say things about the company that you may not have had to deal with in the past. So with that, I'll pass it to Shannon.
Yeah, I mean, in terms of cost, I don't have specific numbers or anything. I guess I would just echo what Francois is saying. Yeah, your costs will go up across the board, probably from a G&A perspective. I think you just hope that your G&A as a percentage of revenue continues to go down, right? I mean, like one of the benefits of being a public company is that you have some, credibility to your brand, and you can continue to grow your business, and you can compensate your employees with equity that's actually liquid. And so, theoretically, your business should be going like this, and your cost should be going like this. So it should be worth it in the end. But I've never really heard a company say that they can't go public because of the cost of doing so. You have to make that, cost benefit analysis and determine that the benefits outweigh those costs and the costs are manageable.
I mean, but in fairness, sometimes plans don't go the way they should. I think the cost of being a public company can drive a company out of the public markets, right? So, I mean, these are real, but I do think this is where being planful and working with people who have done it before makes a huge difference. So, none of us are going to start quoting dollars on this webinar randomly. But just understanding, for me, one of the just most absurd things that can happen is somebody rolls up and says, oh, we're going to be public in 2 weeks. What do you mean? The cost of insurance is more than double my private company spend. Well, of course it is. Of course it is. Your risk is way more than it was. And the fact that you didn't know that until the week before does not speak well to your entire process. So just don't be that company, right? Just include that. The other big mistake is if you ask Francois and Shannon today what costs are, they'll give you a really accurate assessment. Sometimes board members remember going public, in 2001, and that may not be as accurate for 2024 as we may love. So just keep that in mind.
Yeah, definitely trends change over decades of time at companies. I do think that's probably a good segue into just talking about what all of you are seeing in the boardroom. All of you sit on a number of different boards, or you're at least interacting with board members. Can you talk a little bit about any topics or trends that you're seeing coming from your board members? And maybe we'll start with you, Shannon.
Sure. I think this ties back to what we were talking about with the SEC enforcement posture the past few years. And always, but it's just been really highlighted in the past couple of years. Just controls, and therefore, from the board's perspective, oversight, and how to, manage oversight in areas that, the particular board members might not have expertise in. Audit committees are tasked with oversight of cyber. A lot of audit committee members are not experts in cyber. So how do you design a good process to be able to assess materiality of a cyber event quickly to comply with your reporting obligations and avoid investor lawsuits and the like when you might not be expert in that? So I think that's just, it's been interesting to watch board members say, okay, this isn't an area where I'm expert in, but how can we ensure the company is protected here? So that's what I would say. I've worked on a lot of materiality frameworks and things of that nature, which I always kind of instantly reject because I think materiality is such a hard thing to pin down in terms of rank this on a scale of 1 to 5. And if you get a lot of 5s, then it's material. Just from a lawyer's perspective, I'm I don't know if we should look at it that way or not, but boards are really craving some direction here because you can't just say, oh, we'll take everything on a first case, as if we've seen it for the first time. So boards really want a lot of guidance.
So what I'd add is in order to have something to protect, you got to get to tomorrow. I think the big conversations I'm hearing is how are we growing? How are we planning for the current environment? Huge amount of uncertainty. Probably I'm not the only person who noticed that interest rates are up. Right? What does that do for your weighted average cost of capital? Like all those things are so current. And then, oh my God, there's going to be an election next year. And so the amount of time that needs to be spent right now on addressing these issues so that you're making a plan that doesn't fall apart at the first stiff wind is a place where public company boards I think are spending all the time. I mean, I might want them. It doesn't hurt my feelings though that they're not necessarily talking about compliance controls and risk management because it's not going to matter if they don't get to tomorrow. And right now, I think it might be a malpractice if you're not talking about AI. Now, some AI discussions are better than others without any question. And maybe tying back to something Shannon said, it's one of the reasons that you need board members with a growth mindset. Like today, if you're not talking about AI in some way, shape, or form, I actually think it's malpractice. Tomorrow, I don't know what the next thing will be. And it just goes to the point of things keep changing. We're going to continue to have events or opportunities that show up as both risks and opportunities. And so that is the other part. Like a really good board is not just backwards looking or near-term forward-looking, but somehow carves out the time to think about where the strategy and what are some of the risks or accelerants to that strategy. AI is kind of this perfect example. And after saying all of that, I'm really, really worried that what I just said was the equivalent of in 1999 saying why don't you add .com to the end of your name, right? I'm not saying that, but it feels a little bit like that right now.
Shivani, one thing I would add, and it goes to a little bit to both points, but Shannon's especially. The thing that I always found, and it was a nitty-gritty thing that the boards wanted, was putting in place a hotline, a telephone system, an ability for people within the company to report, and then building the framework around that on how that information was captured, who had access to the information. And Shannon, you were talking about how you rank and rate certain things, but then how those things were then reported to the board. Because the board, through all the discussions I've had, the board felt like if they could have this thing in place and they felt comfortable with the framework and the right people who were watching it, monitoring it, and then reporting it up, that they could get line of sight into everything within the company. And that, not in my mind, from what I saw, started to give them more comfort that they could see into sort of every org and every level of a company, and that there was nothing that they were missing. And it allowed them to then make a decision on what they wanted to like spend more time on, investigate more, open up more, who else to bring into future board meetings, things like that. That was, in all my companies, I found that was a big thing, making sure that you got that framework correct. And you discussed it transparently with every board member.
Great. Thank you all for those insights into the boardroom. We are going to just open it up to Q&A in just a minute. So I'll have each of you talk about just one key takeaway for the audience before we turn it over to Q&A. So maybe I'll start with you, Priya, outside of adding possibly like .ai to the end of your name for all these companies. What's your next key takeaway?
I think for a company that is wanting to be a successful public company, it really helps to think about what do you need to do, what makes sense for you to do, and where can you rely on experienced advisors. And what I mean by that is probably just the company that can run the business, set the strategy, and execute against it. But there are all these other things that will trip you up unless you have good advisors. So what Shannon does for her clients at Wilson, what Francois does for clients at KPMG, leaning on external advisors that have the wisdom and expertise when it comes to helping you be a successful new company is a really big deal. And I did it once before, but I'll just finish with another marriage analogy, right? Like an IPO can feel like the wedding, like great celebration. We had an awesome party. And like some marriages are some weddings are very hard to pull off, but that's just the first part. And the being the public company is the marriage, and there's going to be some slog stuff day in, day out. But it's my wish for everybody that you're not just gutting it out till you die miserably, but rather it's a joyful experience because you have these advisors and you had thought about all these issues that we touched on today, and there will be rough patches, which is why you have things like D&O insurance.
Maybe we'll go to you, Francois, next. One key
Yeah,
takeaway.
I'm going to echo a lot with what Priya said as well. It's like, the day after you've gone public, you've still got those next 4 quarters, 8 quarters, whatever else you've got to do. So you're going to continue to have to make sure you've got the right advisors working with you, that you trust them. We talked about this on the first panel about making sure you have people that you can work with, you can trust, that you believe will be in the trenches with you. And then the other thing I would also say, and I talked about this in the first panel, was having somebody who is the PMO, the project manager owner, and that could be internal or it could be an external person. But I think having a PMO to help take you through the first 4 quarters and make sure that you're working across every department within a company to meet and beat on those quarters, I think that is incredibly important, something I would recommend to any company.
Thanks, Francois. Shannon, one takeaway from you?
Yeah, my takeaway is the same as Francois, which is, and I know there are a lot of, non-lawyer business folks on this call. Focus on running the business and ensuring that you have a great business. That's what people care about post-IPO. I'd like to think that what we do at Wilson is very important, but no one has ever said, oh, hey, that's a company performed terribly, but look at how well they complied with all those disclosure requirements. Nobody cares. So the legal stuff we can take care of. That shouldn't be the primary focus. Please take it seriously, but really focus on making sure that your business is ready to go public so that you have just a blowout. I hope for everybody that you just have a blowout first year and you're an IPO darling. That's what I would wish for everyone on this call.
Great. So I will open it up to the Q&A session now. We do have one submitted question, so I'll pose that to the panel. And then if those listening have other questions, please feel free to send those along. So the first one is, how critical would an ISO certification be in terms of signaling to the investors about being in line with post-IPO requirements? Would you advise obtaining one pre or post-IPO?
I'm not an expert in cyber, but I have seen frequently ISO certifications disclosed, for example, in IPO prospectuses. So I think that it's something that can really help give confidence to investors and customers and the like.
Okay. Thank you.
I would echo the same.
And we actually don't have other questions coming through at the moment. So we will leave it open for another minute or two. I guess maybe one other question I'll ask the group while we're waiting to see if there are any other questions coming through. I think at different points, each of you touched a little bit on making sure you have the right team, making sure you're keeping in mind that with this longer runway to going public, there may be some just hesitation about staying in a company that long, just some like antsiness about it. Can each of you comment a little bit about how to think about building your team for the post-public world, and if there's certain highlights or things that companies should be thinking about in that time frame, like after a company goes public?
I'll just start with an observation. I was in a discussion, and one of the parties was bemoaning the fact that as the company was growing and scaling and moving towards the future, a lot of the original people were being separated from, which is, you guys can figure out what that means. And the person making the comment was really sad about it. The founder made the observation, shouldn't you be more sad if you're not seeing that turnover, if you're not seeing that change? Because there's just no way that all the people who were perfect when you were less than 100 people and, new emerging revenue are exactly the same people that are required to run an organization at scale. And what I would add to that is you also don't want to hire somebody who is used to big muscular infrastructure to be the person who shows up to take you through the IPO window or maybe the first 3 or 4 years. So having in mind that people tend to have different skill sets for different stages of the company, and that's okay. And let's just all not fool ourselves about that. Some of the best professionals also, by the way, understand that about themselves. There are CFOs and GCs and others, operators who really understand I'm a Series D through the window guy, and I just want no part of, dividend mature company stuff, as an example.
I think we all see that in the life cycle when we work with companies. You just see that, a couple years out, you get this turn in the head count. Shannon or Francois, other things to comment on from building the right team for the post-IPO world?
Yeah, I mean, I think that I agree with what Priya is saying, but then also on the flip side, not underestimating the people that you do have and their ability to grow into those roles. I have seen plenty of, CFOs of newly public companies that have never been a CFO before that are very, very successful. I think it comes down to, again, having the right chemistry with the management team. If you have someone that's been with a founder for forever and you believe will be persuasive with investors and be able to tell your story, that person might operate very well in a CFO capacity. And maybe what you really need is like a controller or a CAO from a public company, so that you make sure that you have sort of the right, kind of technical accounting and financial controls in place. So maybe trying to find a way to kind of keep the key people that you have, and not necessarily like boot them out because they don't have like the right experience, but just bringing people in to support them. I've seen the same thing in the legal function. A lot of GCs that, never been a GC of a public company before, might have a litigation background. So they're not like, going to be the person that's going to run sort of all of the other corporate stuff that's going on. But so bring in an AGC that is experienced in that type of world. So just buttressing your current management team to make sure that you built out all of those capacities, I think would be the right, what I've seen work most successfully for companies.
Yeah, Shivani, the only thing I would add is, and this was mentioned in the prior panels, is like in that run up to be going through and be doing the IPO, to act as much as possible like a public company and close the books and do all of that good stuff. And that's when you can be assessing the team skills, and Shannon, to your point, maybe bolstering or changing some of the roles. Because Shivani, the one thing that cannot happen is you can't have a team that's running it up to the IPO, and then all of a sudden on that first quarter, you either find that they cannot do it or they all decide they don't want to do it, right? Because you're screwed, right? And so that run up to the time frame, you've got to be, as a leader in the company, you've got to be making those assessments and then feeling very comfortable post IPO. And like to Shannon's point as well, it's a continuing journey. There may be some things, you're getting past that second quarter and you suddenly sort of see somebody on the team that may just need additional help, or they may need, or maybe it's not just the team members. Maybe there's a need to have more sort of a technology, or to build a better process, or to build a better control. There's always multiple things that can be done, but that run up, that 12, 18 months before and the 12, 18 months after, if you, like as a CFO, if I was not spending like every day undertaking some form of assessment of what was happening within the finance function, then I was not doing my role. I had to be doing that, because it's always, you cannot miss certain things. You just cannot miss them.
Thanks, Francois. We did get another question through the Q&A, and this one is for you, Priya. So the question is, curious about D&O insurance. How much does it cost percentage from IPO deal or fixed?
What a great question. Insurance, we are not bankers. It is not a percentage of the deal. Great question. So the way the process works is, if a company is planning to go public, in the best case, and this is how you get the pricing, in the best case, you may have had a relationship with the type of insurance carriers that can take you public even before your plan to go IPO, maybe a year or two before. so that they get comfortable with the story. Who's the management team? Who are you? They expect to see changes. That actually can be a maturing story. And then it's really go time when you're doing your org meeting. That's also when you decide how much insurance do you want, which should be directionally related to your market cap and what will be in float. So the connection to what the IPO amount is the connection to what is in float, because that is your exposure if you have a stock drop and someone wants to sue you. But the process is so much easier than all of the roadshow meetings, but kind of related in that the CFO, very often, if you can get your CEO founder involved, general counsel, they will go to a meeting or a series of meetings where they're going to talk about the company. And one difference between the investing public and insurance underwriters is insurance people experience no upside. So, you've got to be a little thoughtful. It's a little bit less intergalactic domination and a little bit more controls and procedures. We know what we're doing. We have experienced people forecast. And you work with one broker. Multiple insurance carriers won't quote for different brokers. So you work with one broker. It needs to be a knowledgeable broker who can then make a market in your risk. And I had made a comment earlier, there's a lot of capacity right now. We all did Economics 101. When there's a lot of insurance supply and more muted demand, then you get better prices. But remember, insurance carriers don't have an upside, so they would walk away rather than give you a low price if you're not a very good company. So there is a price discovery process that has as the backdrop the macroeconomic environment and also what you do for a living. So if you have a very predictable type of company, you're going to pay less for D&O insurance than if, let's say, you're a hugely valued life science company with a big amount of float and step function outcomes. That's going to be more expensive. And my joke is, of course, if your business model is crypto for cannabis, by all means, call me, but that's going to be very expensive.
Thanks, Priya. So we don't have any other Q&A coming through, but maybe I'll pose one last question to the panel as our last question for the group. And I'd like this to be a positive one. So if all of you are looking out at the market for the next upcoming year, or even into the future, I guess what type of positive feedback would you have for the audience about why it would be good to go public, or different ways to think about the positive spin on what advantages there are to being a public company in the future?
The advantage, right, is access to capital. And also it's a stake in the ground for those who are actually trying to sell their services to anybody. It just feels better for a lot of companies, depending on what you're doing for a living, to buy from a vendor where you see that they're a public company, they're established, there's more information. I will say that works really well right until it doesn't. And we do have clients that end up in a situation where they may need to raise money in a negative environment to demonstrate to their customers that they have a very long runway, perhaps longer than they would need if they weren't in the public eye. So there's a little give and take away, but I think for most people, you aspire to go public when you found the company, and it can be, and to your point, Shivani, it can be a really, really positive event.
I would chime in with, you can finally give your employees and investors that liquidity that they so desperately want. So we're working with a lot of late stage private companies right now on any number of things, expiring options and all kinds of, things like that. So we're working on a lot of existing equity modification programs while this window is closed, and that can be challenging for companies. And so let's go public, and then we can, those issues sort of go away. And then of course you have investors as well that are demanding their own liquidity timelines. So that's one. I agree with everything Priya said, and that would have been my number one answer, but my number two answer is liquidity.
And Shivani, I don't think I would add much more than that. Just to sort of maybe tie it right back to the very beginning when we had Eileen from BMO presenting, I think the markets are going to open up in 2024 into 2025. It takes a company 12 to 18 months to start to really be ready and go through all the different steps and everything that they've heard on these calls today. So the time's sort of now, and it's like, you can start to do things now as a company to be able to meet those benefits that Shannon and Priya talked about, the ability to be a public company, to increase your brand name recognition, create liquidity events, raise capital, take investors off the table, put your cap table, put new investors onto your cap table. Many, many reasons companies, really good reasons companies want to go public. And we're looking at the market. I'm beyond cautiously optimistic. I'm very optimistic. We're going to roll through 24 and into 2025. It's going to be a great year. So, pass it back to you, Shivani.
Yeah, no, that's a great positive note to end on for everybody. So thank you all for the time. I'll turn it over to Colin.
Awesome. Well, Shivani, Francois, Priya, Shannon, thank you so much. Francois, I love the beyond optimism. And for everyone else on the call, we want to thank you for joining us. Hopefully this session and this boot camp was insightful and helpful. We love your feedback, and if you're interested in meeting with any of our partners, please use that link in the chat. Also, if you missed any of the sessions today or want to recap, you can check out everything on our YouTube page, but we look forward to welcoming you all online soon. And again, Shivani, Priya, Francois, and Shannon, thank you so much. What a way to end the day. Thanks so much.